once the worst of the flight to quality in the dollar is over from a domestic perspective, we're going to see a sharp rise in gold. We still may get another dip lower, but gold is going to just be volatile until it finally takes it makes a directional move, and that directional move is going to be higher, not lower.
The gold market and some of the precious metals have kind of been taken off, obviously, with what we got going on in with like the geopolitical situation with Israel and everything, all the invasions, and yeah, I mean just a lot of craziness kind of going on. So I'll just leave it kind of broad. I don't know who wants to take the floor first, Bob or Tom, but what kind of things are you guys seeing out there on the precious metal side? And let's dive right in.
Yeah, Tom, if you want to kick it off, I guess with the Israeli thing, and yeah, that I'm not an expert on when it comes to some of this geopolitical stuff. So
Oh,
maybe if you want to lead with that.
yeah, I'd be happy to, Bob. But this is fine if you wanted to take the lead. It doesn't either way. It doesn't matter to me either way. As far as what's happening with it, there's a lot to unpack with Israel and Hamas and everything, and I don't really think we have a good handle on what the implications are and who did what. And I mean, we mostly know what happened. Now the question is the whys and the wherefores. Is I think the bigger issues. If we want to talk, we want to talk about what that's going to do with gold. Well, the short answer is that it's not good what's happened here. So this is from a geopolitical perspective. It's good for gold. Like, it can't be bad for gold here. People are just not gonna are not going to be feeling they shouldn't be feeling any more safe about the future of the world, to be honest with you, to put it bluntly. So, yeah, I mean, and I think that the move in gold recently has been, that's clearly a dollar event. And, once that plays itself out, I think we'll see a sharp rebound in the gold market because of things like this.
And Tom, to add to that, my question is obviously something that's been precedent on gold markets is real yields in relation to gold value. If we were to look at historical progressions, we would think that gold should be priced around roughly $1,600 to $1,700 an ounce in relation to where real yields are. And do you think that given the increased inflammatory situation, geopolitically speaking, this is where we're seeing the more risk-free type assets giving and having a bigger bid in that sense?
I don't know. I mean, the argument about gold and real yields and all of that at this point is really specious because I just don't trust the CPI. And I think we also have to realize that we have incipient inflation coming back anyway because oil prices are rising. So we're going to get out of this issue. We're going to get into a very different place with gold when as this next phase in the commodity bull market plays itself out, and the loss of confidence in our political leaders starts really taking hold. It's already there, but there's still this disbelief or willingness to disbelieve that the whole thing is, or willing suspension of disbelief is what I mean. That everybody is that the cooler heads will eventually prevail, and I just don't see that at this point. I think that's what the lesson from Sunday's events really are. That cooler heads are not prevailing here. And when things like this happen, then it means that, eventually money has to go to ground. And once the worst of the dollar, the flight to quality in the dollar is over from a domestic perspective, we're going to see a sharp rise in gold. We still may get another dip lower, but gold is going to just be volatile until it finally takes it makes a directional move. And that directional move is going to be higher, not lower.
And I think the best person to talk about gold volatility in relation to you would be Bob. So, Bob,
Sure.
What have you been seeing in the gold market and silver markets in the sense of volatility, market participators in the sense of how they're anticipating price action?
Yeah, I think I mentioned a couple of weeks ago on this gold volatility index that you can kind of track on Yahoo, I guess, and the symbols. I guess on Yahoo, it's that caret sign GVC, Golf Victor Zebra, and that hit a low of like 10 something a few weeks ago, a couple weeks ago, which kind of corresponded to this almost like this death-like atmosphere that we saw in sentiment. You saw the bullish percentile gold miners index dropped to like 10.71, and DSI was in the single digits, and I know Fred Hickey kind of made some interesting comments with the correlations between 4 days straight on the DSI and similarities to what happened in 2018 when gold was like 1188, and then prior to that in 2015 when it was about a month away from its lows of 1050 or 1060. So sentiment really got washed out, and from what I kind of gathered, trading desks out there are, especially on the refinery side, and they're looking at building their option side of their business. Because of the low volatility, they're expecting volatility to start rising, which they can obviously, with a smart options trader, you could try to profit on rising volatility. So that's something they're seeing coming, I think, into next year, trying to position their trading desks as such. And that's one of the things that, these refineries have turned themselves into a quasi sort of broker dealer in a way. They're doing the similar trading desk types of things that you typically would see at a Goldman Sachs or Morgan Stanley. But what's interesting is Goldman Sachs, if you look at their trading desk, or I'm sorry, not trading desk, but their derivatives book, they have actually, based on the opposite controller currency, they've almost cleaned out their entire book in the precious metals sectors, which is kind of strange. But I think that's probably this deleveraging that's going on as well, and I think that's going to actually help gold stabilize. It's probably one of the reasons why you haven't seen this, maybe nosedive to 1,500 that some of the bears are talking about, because you don't have as much of a leveraged market as you did, prior to COVID, especially back in 2008 when that financial crisis kind of erupted. So you don't have as many players trading the market on margin or leverage, which is what that Basel III was all about. But what's interesting, since this disaster in Israel over the weekend, you haven't seen a lot of physical activity on the retail side. It's almost like the retail sector doesn't really believe the move, or they think the market is going lower, which I find very interesting, because you're starting to see some of the tacticians who have been looking for lows in the metals. They're starting to call these buy these these buy recommendations, and starting to look at maybe from a longer term perspective, this is probably the place to start going into the market, expecting a solid move forward. Obviously, picking the bottom, you could get another washout low, something like that. But I think if you start to see, whatever happens with the Middle East, at some point it could affect, if it starts to affect the financial markets. The strange part about the Middle East, and you look at correlation to supply coming out from the U.S. Treasury, and Yellen coming out, I think yesterday, talking about how trying to calm the markets on the Treasury side. I think there's a big worry that higher interest rates are really starting to impact the economy in many different industries, and we've seen that with the metals markets. And I think you had what was it? The Mortgage Bankers Association came out with a letter to basically complaining that we need rates to come down because the monthly payments are getting so high. Well, whatever happened to house prices coming back down a little bit?
Oh no, we can't have that, Bob. Please, please. You're giving people the vapors and saying this. You can't have our asset prices go down. That's our credit-based asset prices go down. That could never happen.
Our asset inflation being broken within the last 23 years of this market participation continuously go down. I agree with you, Tom, on that sense, right?
It's great. Well, it's just crazy to say. And all I say, Bob, is I mostly agree. Like but don't think that the Fed is going to cut interest rates anytime soon, because they're not. Powell is on a mission, and that mission is to break the Fed put and to regain control of monetary policy for the United States, by the United States, of the United States. The hell with Europe, the hell with London, the hell with Hong Kong. They don't care. This is the era of the Eurodollar system running the show is over. And what you're hearing from all of these people, it doesn't matter if it's like the letter you just referenced from the Mortgage Association or anybody else, it's all the same thing. It's all whining because they're used to this and they've been built on this. And I've been making this point for 10 years that most people who trade bonds have never traded a bear market in a real bear market in U.S. Treasuries because we haven't had one in 50 years. So there's nobody under the age of 70 trading bonds who's actually ever experienced what a bear market in U.S. bonds looks like. They've traded bear markets corrections within a primary bull market, but they've never traded a primary bear market with bull market corrections. And this move today is a classic kind of bull market. It's kind of a bull correction within a primary bear market.
And Tom, that's an important highlight that you're bringing up, and specifically market participants and how they're going to react. Obviously, we're already seeing it. They're reacting and flowing their equities, passive flows towards money market funds in that sense. And so what do you think is essentially, in your perception, is the big risk behind this higher for longer type aspect and essentially a bear steepening within the yield curve, right? We're seeing the longer end of the curve meet up the shorter end. And so that makes the environment slightly more nuanced, right?
Yeah, no, I've been calling for a bear steepening all summer. Like back in at the beginning of the summer, I said the yield curve's going to normalize on the long end. Like Yellen is going to lose control of her yield curve control policy that she and Lagarde have been running. They've been running a psyop on everybody on the 210 spread all year. That's exactly the way I see it. Like Yellen's been oversupplying twos and undersupplying tens. Lagarde and all of the European central banks and their proxies have been buying the hell out of U.S. Treasuries while Asia dumps. I've been breaking down the TIC report on a monthly basis by region for the last 2 years, and it's clear what's happening since Lagarde announced the transmission protection instrument where she would protect credit spreads last July, when Powell raised by 75 basis points again. It's been very clear. Europe buys. Asia has been selling. It includes Japan, mostly Japan, and the rest of the world is kind of meandering around. And there was, when the euro hit 95 cents or 96 cents last October, that's set off, a kind of a counter trend within what I just described. A little bit of selling from Europe, a little bit more buying from Asia, blah, 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 blah. But then the minute we got past March and the banking and the 4 banks failing in March, and Powell was like, yeah, I'm raising rates while there's a banking crisis going on. If anybody didn't get the message, I don't know how much bigger a message you need to get from the Fed chairman. I raised rates by a quarter point after 4 of the biggest bank failures in U.S. history.
Now, this is another, you're spot on with a lot of these points. But so we know that Jerome Powell, due to that effect, right, was willing to say, I'm going to bring in new regulatory environments in order to mitigate the compression, specifically margin compressions we're going to see in long duration books, specifically when we're looking at banking institutions. So obviously, do you think that we're going to see more BTFP programs in a longer term BTFP program? We're supposed to see it redacted roughly in 2024 midterm, right?
Yeah, I mean, look, the BTFP is what's the latest number on it? 115, 118 billion dollars. It's nothing. It's a rounding error. On the Fed's balance sheet, the BTFP is nothing. If it was what the banks wanted, the balance would be $2 trillion. It's not what the banks want. The Fed told, as Daniel DiMartino Booth said to me back in June when we spoke on my podcast, I asked her about this, and she said, no, the BTFP is not going to be used as a means by which to shore up the bank's balance sheets. It's literally an emergency program and the Fed saying directly to the banks, go raise capital, because that's what you need to do. You're undercapitalized, and if you want to swap out your undervalued sovereign debt at 70, that's trading at 70 cents on the dollar and trade at par, well, you got to pay me 5.5% to do it. So every time Powell says higher for longer, the BTFP as a thing, it doesn't it doesn't wash. It's not. It's literally for emergency liquidity for the banks to, in the worst cases. But otherwise, they're being told to go raise capital. I mean, I think the Fed's literally telling the banks it's okay. You know what you have to do. The party is over. It's now time to shore up your balance sheets. It's now time to raise capital and do what you need to do. And we're not coming. We work for you. We're here for you, but we're not here for you the same way that Yellen and Bernanke were, because the rules have now changed. Because if we don't get this under control, there won't be an American commercial banking system. Europe will win. We'll wind up with CBDCs, MMT, and minority, as I have tried to popularize, Minority Report, but with more Germans. And like that's the stakes for the Fed. They don't have any other options here. And so, I mean, I'd like to hear something. I'd like to hear somebody tell me that the Fed has some other way of getting out of this mess and saying, oh, well, we can still be the central bank of the world and, not trash the dollar and not enable the worst kind of spending imaginable on Capitol Hill. Because look what's happening. The Fed has raised to 5.5%, and now we have a political revolt on Capitol Hill over overseas spending on unnecessary wars. This is exactly what we've all been bitching that we want the Fed to do for 15 years, and now it's here. And we're not worried about it. Like, dude, this is what we wanted, but we're going to have to take the pain. There's going to be banks that are going to go under, probably hundreds of them. There's going to be a long, ugly stagflationary recession. This is what I'm seeing. And we're going to see a replay of the 1970s. I mean, look, the central bank, the coordinated central bank era of 2011 through 2021 ended. Similar to when the London gold pool failed in 1968 and then ushered in the dollar reserve standard in 1971, we're in the middle of an ugly 3-year negotiation, roughly, I think is where we are. And we're going to have a decade of really bad times to work off the excesses of the previous era, which in the case of the London gold pool failing was Bretton Woods. And in this case, it's going to be, the Yellen-Bernanke experiment with going to the zero bound and, $6 trillion worth of QE or more. Like, that's what I think is happening. And if you look at it from that perspective, what happened with gold during that time? Gold went to the moon because it had to. It had to balance the books. Now, this time, are we going to balance the books in the same manner, the way Volcker did? I don't know. If we do, gold is going to some ludicrous number. But I think something else is going to happen between now and then. I think Volcker allowed gold to go to 800 because he wanted to establish the U.S. Treasury bond as the supreme instrument in the world and fully remove gold from the system. That was the situation at that time. Today, gold has been completely removed from the monetary system. I think gold returns to the monetary system, and I think that's the way the Fed helps us get out of this, and all the central banks are going to do it. And the truth of the matter is that geopolitically, and I'll shut up in just a second, let Bob take over. Is that geopolitically, if we don't do this, the BRICS are going to do it for us, and they're going to do it first, and then they're going to force us to do it. Because that's clearly what they're signaling.
So I do. Go ahead, Green Candle.
I was just going to pass it to Bob if he had any follow-up or anything that he wanted to add to that, and then we'll go to Phil, who's got his hand up.
It seems to me the BRICS thing is more about almost like a unionization where they're trying to survive in this world of their own economies that are tanking or currencies are going down, and they're trying to create some sort of unity, I guess, with regard to trade. And but to try and compete directly with the dollar, it's the only. I was going to do something with put something on Twitter, but of the BRICS currencies, was it Brazil's the only currency that isn't falling like a rock? I mean, they're all the other ones are.
I know, Bob. All I'm saying is that yes, you're exactly right. Competing with the dollar at this moment in time is madness. That is not what they're trying to do. What they're trying to do is move away from the dollar with trade as much as possible in their individual trade settlements, or as a block their trade settlements, and then how they're going to ultimately account for all of that is they're going to effectively settle up the differences in gold, credits and deficits on each other's balance sheets, and that'll be the system. It won't be trustless. It won't be I don't think it will be, but I think that's what they're going to move towards. And once somebody offers a convertible bond into that's payable in national currency plus gold, some small percentage of gold, even a small percentage, that's what opens the door. And that country could be China, that country could be Russia. But it's going to happen. And I think those are the two likely candidates. And I think the Russians are probably the most likely candidate. But they don't have the financial system depth at this point, and neither do the Chinese, to be honest with you, to handle the inflows that would come from that. So it's not tomorrow that these things are going to happen, but it is what's on the horizon. And you can see the Fed taking the steps now to shore up their own monetary system here domestically, implement SOFR, get the banks working on working in a different environment, get used to that environment, clean up the balance sheets, liquidate a whole bunch of unbelievable investment, and then prep for the second half of this decade, where that and the potential political reform for spending in DC on Capitol Hill, and then think 28 through 2032, that time period. It becomes a very interesting time. I don't know that we pull it off, but I know that's what the Fed's trying to set up. At least that's the way I read it now. And nothing has happened in the last few years that has changed my opinion on that. Even when I first put this idea together, kind of almost out of, is this what the Fed's doing? And then it went from there.
So what you're saying is the Fed is trying to choke the economy down, I guess, to kill the inflation.
Somewhat. It's really about the leverage in the offshore dollar markets. It's about having control over the price of dollars in such a way that that when they make monetary policy, it sticks. That was never the case before. In every other cycle, we've always lived under this regime where LIBOR was the law of the land, and where if a London bank got in trouble, your lender raised the interest rate on your credit revolver, on your credit card, on your adjustable rate mortgage. You paid the price for London's lack of vision, to quote Emperor Palpatine. And that's kind of that is what's changed, and that has not propagated itself through the financial zeitgeist at this point. It has not quite sunk in with people that the United States literally has finally declared independence for real. And that's what SOFR is in my mind. And if I wind up being wrong about this, well, then, I'll have a very short career in this. But if I'm right, well, then I'll be able to do this until I retire. That's kind of my gambit at this point.
Sure. Do you want to have Phil come up, or?
Yeah, sure. Phil, what you got?
I'm up. Good evening, ladies and gentlemen. I just wrapped up at Walmart to grab some gas, fill up my tank for a cool $2.96 before oil blows the fuck out. But needless to say, Tom, I want to pull on a few threads here just to codify the last point. And I will speak in these terms because I don't give a shit. We were tied to the globalist ball and chain that was LIBOR, and SOFR completely changed that. And Tom, I don't know if you remember, I've been on record saying that I literally had a shower epiphany, and then I'm like, holy shit. Then I DM Tom and I'm like, if we have SOFR, why do we need the Fed funds rate in the first place? Then he was like, we kind of have a point because Martin Armstrong basically said that's how the original Fed charter was set up because there's 12 regional Fed banks. Right. And so, I mean, I would love to see in my lifetime that we don't have to live under the Fed funds rate when each independent, unique part of the country has a debt indexing rate that represents the different microeconomies where each Federal Reserve Bank lies.
Right.
So, I mean, what are like the probabilities of that? I mean, I guess we have to see if we actually flatten out the yield curve even more, or what?
Well, Phil, it's a fascinating point, and it's way to the end. And you and I did have this conversation, I don't know, about a year and a half ago. What I'll say is this: SOFR, and I brought this up to Danielle when Danielle DiMartino Booth, when I had her on the podcast, and I brought this point up to her, and I asked her this, and she said, well, New York will never give up that power. And I went, yeah, you're probably right about that. But they may not be able to hold on to that power. They'll hold on to it for as long as possible. I mean, and this is the thing. Let's not get too far ahead of ourselves, but that would be absolutely one of the things we would like to see, that with SOFR as our debt indexing rate, now debt can be priced as a discount or a premium to SOFR, regionally, in a way that we don't necessarily need the Fed to do what needs, to set one monolithic rate, and just be out there to go back to its original charter and provide elastic money when somebody gets in trouble, of temporary elastic money that's necessary to keep the banking system liquefied, to keep the economy from collapsing. Which is, when we go back to the Panic of 1857, which is exactly what James Buchanan did, and let the banks hang, and short up the state banks with enough silver and gold specie to ensure that the local domestic economies had enough money to keep operating. And he said, he let the banks hang. Guess what happened to him? He got primaried out. Like, he wasn't even the presidential candidate of his own party as the sitting president in 1860. Like, this is a big deal. What's happening? What's coming next? And I don't know that we're going to get to that stage. Let's not go to step 7 or step S when we're still on step C of the quote unquote the plan, whatever the plan happens to be, because there's so many twists and turns between there and there.
And I also noticed the space is tiled precious metals with Tom. I don't know if you already covered it yet, but if you could, I think we can kill 2 birds with 1 stone here in discussing how you and Vince had that discussion of the Americans, sovereigntist plutocrats, as we like to call them, are going to be working, probably already in discussion with China, with Japan, with BRICS, and how Vince used that example of setting up a gold shop overseas and kind of getting rid of this mercantilism thing. And I think that also ties in to explain why Powell in the past has said there's more than enough room for more than one reserve currency. So can you kind of explain that, like, gold shop working internationally and how that kind of proves how and why Powell wants to, make peace with not being the world reserve currency of the world?
Well, let's put it this way. Powell understands that, because I think he's made this clear. Powell understands that we've reached the limit of what we can do with the dollar as the global reserve currency, and that it's a burden that the United States can't afford anymore. So, Triffin's paradox is finally, bit everybody in the ass, right? What Vince and I were arguing in a podcast we did recently, is that, and he came up with this idea as much as anybody else, Vince Lanci, and which is this: that China's not allowing any gold to leave the country, right? The Shanghai Exchange is a fully physical, settled exchange, and you can mine it, you can own it, you can buy it on the Shanghai Exchange, you can store it, but no gold at scale leaves China, right? Well, what Vince is arguing is that the same thing is happening here in the United States, and this is actually tangential to something Bob said earlier, and I want Bob to chime in here in a second, which is that the COMEX is being drained, right? But why is it being drained? Is it just because all the gold is going to China or going to points east? Probably. And then what happens when they don't replenish the COMEX, right? Let's just posit this idea that, and this is what Vince is positing, that gold speculation will move off of the COMEX and into GLD, and silver speculation will move off of the silver COMEX futures contract and into SLV, where you'll get settled in cash because nobody other than trusted merchant banks by the federal government will be allowed to move gold or silver out of the country at scale, out of those repositories effectively, without a prior approval from the government, which is an effect of saying gold is going to sit in people's vaults and not move, and it may circulate domestically, but it will not circulate out of these countries internationally. And the Russians are going to, if they haven't already done the same thing, they do a little bit here and there. They shut it down, then they let some of it out. For the most part, the Russians have so much gold it doesn't matter, especially relative to their economy. So they can sell some tonnage into the market because they have more than they need. But to that point, I think it's really interesting, an idea that Vince floated, and he and I have been trying to run with that idea and see where it leads. So again, so that's what I would ask Bob here. Like, what do you see with the COMEX, like, and the LBMA to a lesser extent? What do you see is going on those exchanges granularly? Because I don't follow that stuff on a daily basis.
Sure. Yeah. With the COMEX, you've seen that, since 2020, you had a big rush of metal coming into the COMEX, and that was more partly on the supply chain issues, the collateralization issues, and then also the blowout between the EFP, or the spread between the London spot price and the New York front month or lead month futures contract. You had that blowout in spring of 2020.
Right.
And then interest rates obviously went to zero. A lot of metal went onto the exchange because then it was collateralized and you could loan against it. And then also you had the arbitrage between, obviously, the spreads between London and New York. And then interest rates started to rise. And you obviously, during that 2020 2022 timeframe, you had a lot of, especially in India last year, you had a lot of physical buying internationally, and a lot of the metal moved out of the U.S. and London to meet Asian demand. But the metal inventories continued to drop, and part of the reason why they continued to drop was interest rates were starting to go up, and it didn't make any sense, because leasing rates started to rise, financing costs started to rise. So a lot of hedge funds and guys that were maybe borrowing gold from central banks or bullion banks, putting it onto the exchange, and then borrowing against that to basically maybe buy another asset with it. That financing just got too expensive. So then they basically were reversing that trade, and that continued to move gold and silver off the exchanges. What you kind of seen here in September was you had, I think it was like 12 million ounces of silver come onto the exchange via JP Morgan. You're starting to see, with interest rates high now, the contangos have gotten to a point where it may make sense for a refinery. Basically, over the summer, the market started to slow down. The physical activity started slowing down. By June or July, the refiners were holding on to inventory, not putting it on in the exchange, expecting, okay, the next event is going to drive the retail coin and bar market, so we got to have the inventory on hand and not put it on the exchange and go through the costs of delivery and storage, transportation, all that. So they were holding on to it. Well, by September, you started to see the markets weren't really picking up at all. I mean, they're just, you had the BRICS thing in August. Everyone was looking for, you had a lot of noise going on with that. Nothing panned out.
Right.
And so the refiners and fabricators, whoever's sitting on the metal with inventory, said, listen, we got to get some cash flow from this metal. And so metal started to go back onto the exchange, and then they sold futures contracts against that, kind of like, just trying to make money off the spread, kind of like writing covered calls type of thing.
Right.
Very similar. So they're just trying to get some type of income off this metal, because until the market starts to pick up, mining activity is still going. You're still seeing this. You're seeing sovereign mints around the world slowing down production. They may start to lower their premiums on their products because their inventory is starting to back up, because just the investors out there aren't chasing or aren't buying the physical metal. And one of the reasons, well, a couple of the reasons is, the very high premiums that we've seen the last 3 years in the market, that's scared people away. But more importantly, you can get 5.5% on a 6-month T-bill. Why take the risk and the volatility? It's just it's a risk-free rate, even though obviously treasuries are, it's another rabbit hole to go down in terms of quality of treasuries. But the idea is that there's more competition for the metals right now, and that started to. It's something I was kind of warning people on over the summer. And it's something I talked about at the Silver Symposium the other week. Was you're going to see dealers and the industry try to get more creative in marketing to try and get people into the metals. But I think it's this, unless there's another event, I think the public isn't really. I think they got burned a lot by buying silver with 40%, 50% premiums, and now they're sitting there saying, oh God, now I got to have a $15 move silver just to break even at this point. And they've walked away, and it's something I worried. We did a Spaces, I think November of last year, and I said this is a big concern because the industry was just making too much money off the consumer. But I think what I see happening going forward is which is not going to be good for the industry. Is that the markets find some bottom here and start to grind higher, and the public's not going to trust that rally, and the public's going to start selling into the market as it rallies, thinking, okay, high interest rates, I can just finally get out from underneath this metal, I can put it into a 5.5% yielding instrument, whatever it may be.
Right.
But I think the public's not going to trust this, and that's going to keep sort of inventory levels high on the dealer side, the profit margins low, and the premiums low as well, because the premiums have crashed.
That's good.
But that's good for the consumer, which it's one of those things when you see an industry that's profiteering and making a fortune, their time is limited.
Yeah.
And when the bad times come, it gets really bad. And I think this is something that I think and not the macro scale. I'm kind of looking more on the micro stuff here, but where individuals have to really understand their counterparty risk. These structured programs like ETFs and all these other allocated and pooled programs, these guys are going to see almost like a attrition, I guess, of assets because of what these high interest rates are bringing. Because in all honesty, we haven't seen this high of a rate since early 2000s.
Yeah,
I mean, this
is a long time.
Yeah, so a lot of people, it's just like when Silver Eagles, finally crashed in premium over the summer, and everyone started buying again because there was a lot of pent up demand. Well, there's a lot of pent up demand just to get some income, especially if you're retired, so you can live off of it.
Yep, agreed.
Without draining your capital. But these take time to work out. I think once that works through, the sad part about this is, the real interest rate argument versus gold and silver. The bigger issue, I think, is the ability to maintain the debt servicing with higher rates. That becomes more of an issue, and insolvency and all the other things that go along with that. And that maybe is what gold and silver are pricing in, and why they're not at 1,600 or 1,500 like some of the bears are calling for. And at the same time, the cost of production has been rising on gold and silver producers as well, and that tends to create some type of floor as well. That we've seen in the past levels where the market tends to bottom out at, which is very close to some of the primary silver producers, as well as some of the big gold producers. But those are it's not just simply looking at these big countries like China and because the Chinese, one of the issues I'm concerned over with this high premium that they've had is that, about in August, you started to see the top 10 Shanghai traders on the Shanghai exchange they took very, very big long positions in the metals. I think their largest long position of the year, right ahead of concerns about the yuan devaluating and all that kind of stuff. So and then all of a sudden you saw this, in September, the blowout of this this premium, as well as you had import quotas and all this other stuff that was going on. To me, it was no different than what was happening in the gold and silver industry, marking up premium, distributing the product, and making a fortune off of the high premiums. I mean, it's basically the same thing that happened in China in a way.
Yeah,
it's just
the one thing about the only thing I'll say to that, and thank you, that was great, is the following, and this is what got Vince and I talking about this, which is that premium in Shanghai over the U.S. wouldn't close. And when you see an arbitrage opportunity like that, gold is a pretty easy thing to arbitrage. To see it not close is telling you that there's something else happening. If it continues to persist, like if this goes on for another 2 or 3 months, like all of a sudden any short-term concerns over the property markets in China, for example, because I heard that argument, and I'm not even discounting it. I'm saying, yeah, one of the other ways of looking at that premium was that there was a lot of uncertainty within China over what was happening in the property markets. People got scared. They ran into gold. They pushed the price up, and then the market couldn't close the arbitrage between the London and Chicago and Shanghai fast enough because they couldn't move the metal around fast enough. Fair. But the other possible scenario here is that there's something else happening. And that's what Phil and I were alluding to earlier. And it's just something to keep on our radar, something we should think about revisiting in 3 to 4 months. If we are still seeing a 6% premium in Shanghai 6 months from now, I don't think it's that. Because the ARB players around the world should have ground that out. You know what I mean?
And my question to you, Tom, comes to, is it because they have an informal capital control in place within China? Yes. And specifically they want to control and concentrate all of the influx of large gold concentration that they have within their basic consumers? Same thing with Russia in that sense, right? So Absolutely. It's like this caveat, right?
Yeah, no, that's exactly what's happening. The Chinese are explicit about their capital controls. Vince's argument, again, he made these points. I didn't. I always like to give credit where credit is due. Is that we're the U.S., we don't do capital controls. We're an open market. Yeah, right, we're an open market. We're not, but we say we are. We project that we are. So we're not going to do that. We're just going to quietly sunset the COMEX gold contract because we don't need it anymore. We'll move it over into GLD, and we'll move people over into GLD who want to speculate on gold for the purpose of using gold as a key bank for hedging dollar risk. Okay, that's what the gold futures market, for the most part, on the COMEX is used for. You see it in any time. That's why it always gets rated hard during big dollar squeezes. Like this is what happens. People take a long position in gold because you make your calculus, whether it's real interest rates or whatever it is, and you take gold long positions to liquidate if you need to raise dollars. And gold is the easiest thing to liquidate, and always the first thing liquidated when people need dollars badly. So that makes sense, and that's part of what the gold futures contract is supposed to do. We don't necessarily need to do that. We can have it with a dollar settled GLD and an options chain on GLD. Not to say that those things haven't existed in the past, but I think that's what's coming, because JP Morgan was made the JP Morgan and HSBC are the two custodians now for both of those ETFs. That's it. So we have a Hong Kong bank, we have the premier U.S. bank, and that's it. And they're going to be the only ones who can take physical gold out of GLD or silver out of SLV and move it at tonnage to someone else who's willing to buy it, but it'll be at a negotiated price off exchange where it's not quoted. That's what I think is the long-term thing that's coming. I think Vince is completely right about this. I happen to be, because it makes sense with everything else that's happening geopolitically, right? And we're globalism is over. So coordinated central bank policy and QE are over. What comes after that? Well, a re-regionalization of strategic markets. is what happens at that point. Strategic markets being aluminum, copper, gold, silver, oil. Blah, blah. Oil, it's not really because it's produced, you know what I mean? But the things that are important won't be moving around the world on big, on big ships burning number 6 bunker fuel. It's going to stay exactly where it is in the country that it was produced, and people are going to scramble for it where they can. And anybody who wants it at scale is going to have to pay through the nose for it, and they're going to have to pay for it through certain players who are politically connected. It will not be an open market. That's what I say.
And don't you think that presents like the highest level of risk in essence, right? We just need to allude to the two players you mentioned, JP Morgan and HSBC. JP Morgan back in 2010 had one of the biggest 11 billion gold scandals that we've seen on COMEX. And then we jumped to HSBC in 2013 with their money laundering schemes, specifically revolving with gold included within the money laundering schemes, right?
Well, I mean, the thing about JP Morgan is that everybody freaked out last year when they finally came clean about where they were hiding their gold book. They were hiding it in their Forex reserves on their balance sheet. Now they finally just moved them officially out of their Forex reporting category and into their gold and into their, I guess, their commodities division. And you know what I mean? Like, JP Morgan is not going anywhere. Okay, they're the most politically connected bank there is. Like, JP Morgan is the Fed. Like, when we start talking about the Fed, like,
I was literally about to say that.
Yeah. So, like, there's no way imaginable, and is JP Morgan going to be in a problem here? It's not going to happen. Like,
you're 100% correct. And same thing with HSBC.
Mm-hmm.
Guess who was the defendant and the lawyer for their defendant cases on HSBC in 2013? It's going to shock you.
Not really, but tell me.
Jerome Powell. It was Jerome Powell. When he was working for Davis and Polk, and he was the consultant, right?
Yeah. So anybody who tells me that I'm wrong in thinking that Jerome Powell isn't still working for the big banks on Wall Street, you're crazy. Of course he is. But that doesn't mean that the big banks on Wall, and maybe then you ask the question is, what do the big banks on Wall Street actually want? Do they? And this is when I used to make this point like half facetiously, or I try to be funny about it, which is to say, does anybody really think that disagreeable Greek bastard Jamie Dimon is going to, hand the keys to the JP Morgan candy store to Klaus von Schnitzel wearing a Klingon outfit? Does anybody believe this? Because I don't. Like, I just don't. Like, what I see is they're not going to go full. We're not going full MMT retard. We don't have to. Dimon's made this very abundantly clear. He's like, drill, baby, drill, and we're going to 7% interest rates. Like what he said, like flat out. He did it at Davos this year, like in the parka on CNBC with the ski lifts in the background. Like, oh no, this is what's happening. And it was like, I never saw somebody walk into a convocation of oligarchs and whip out his Johnson and piss on the living room carpet like Jamie Dimon did. Like, it was the biggest, like, power hands move I've ever seen. It's like the way he treated friggin' Rashida Tlaib when she was like going on about the end of oil. And he's like, yeah, that's not happening. Like, I just don't see it. Like, we're gonna get back to there's gonna be a return to something close to normality eventually, but we've got a lot of work to do to get there, because I really do believe that the way these people are signaling, yeah, okay, the years of excess are over. Yeah, we have control of our monetary system. Yeah, they want to do this. No, we're not doing that. And you have to ask yourself, if they were still globalists in the same way that they were 10 years ago, would SOFR even exist? Why do we need to get rid of LIBOR? LIBOR was working for them perfectly. I mean, unless you just want to argue that our oligarchs want to run the world as opposed to the British oligarchs, that's a specious argument at best. Because you don't have an America if we keep going down the path that we were going. What we have is a United States that has to break up and has to implode. And that's when I start getting into my arguments about why is it that this is happening? Why what are the Fed's incentives for doing what they're doing? If Powell was a private equity globalist, we'd still be at, like, he would have raised the 1% and stopped, and then gone back to the zero bound. We're at 5.5%. That argument is complete nonsense. The private equity guys can't get him on the phone. They're the ones screaming the loudest right now.
One thing I was going to mention with the ETFs, HSBC has been actually they've been actually getting out of the business, reducing their trading desk, reducing their exposure in the ETF market. If you look at and JP Morgan's obviously become a stalwart with, now they're 100% the depository for SLV. They're over 50, I think it's 53% of the gold and GLD is being stored at JP Morgan in London. But with the ETFs, though, the way they work, JP Morgan is just a custodian or for the metal. It's the authorized participants that actually will create and redeem shares. So it's the more on the authorized participants are typically like your broker dealers, that type of thing, and they're listed amongst in the prospectuses of each one. But those are the ones that actually will that actually trade with and against the ETF as they create and redeem shares, as they make money on the arbitrage between the discount and premium to the NAV or to the underlying instrument. If it's SLV, it's silver in that case. So one of the things that I've been arguing, people are trying to say, well, why the hell isn't the silver market been going up? And the problem that I've seen is it's the ETFs that they're part of the issue, because the authorized participants may be using their own inventory to trade with the ETF and to absorb flows that are normally going into the silver market, that potentially could be actually going to buy physical metal. This ETF has been created to make it a lot easier to get price representation of the silver itself. And that's so the ETF structure, I think, is dying. I think if volumes start to wane, I think you're going to see it's going to be more difficult for the authorized participants. They're going to have to create more volatility in these ETF shares, meaning when I talk about volatility, you're talking about premium and discounts to NAV on a daily basis, where they can actually extract value. So, for example, if like we just saw, and most people may not be aware of this, but just in the last 20 days or so, you've had 20 million ounces or 20 million shares created in SLV. And as the market's been laying over and sort of you would think would be dead, but there are points where you've seen some really sharp discounts to NAV, and that could have basically been authorized participants, for example, buying the shares on the cheap and then delivering the shares and extracting the silver out, or in the opposite, if the shares become very expensive relative to the silver, they'll actually deliver silver, take the shares or create shares, and then sell those shares into the market. And then they can wash, rinse, and repeat this whole cycle of allowing the thing to go to a discount. They buy back the shares, they deliver the shares, get back their inventory of silver, and then it's just a constant game of almost like managing not necessarily the price of silver, but managing the flows that are normally going into silver. And then the other thing is, when silver is pulled out of the ground, people look at the COMEX as if it's evil, but the problem that the COMEX is, it's a seller's market. It's designed to hedge, and so that 1 ounce that comes out of the mine that goes to the refiner or goes to a smelter or goes to a fabricator or goes to a wholesaler or a retail dealer, that 1 ounce that as it travels through the system is constantly hedged, because nobody wants to take the risk of the volatility of the price ruining their profit margin. So that 1 ounce that may be created and flows through 6 different hands could be shorted 6 different times in the market, and that's where you get a magnified effect of this sort of suppression or influence in price. And that part, I think, needs to be kind of explained, I think, to the public a little bit better, because it's so easy to jump down this, every market's manipulated. I mean, it would be if not manipulated, managed, I guess would be the proper word. But what I'm trying to do is get the institutions and individuals that are looking at the silver market and gold market not to do these structured products, because they introduce so much more risk into the system.
Mm-hmm.
The ETFs, they're just in essence, at the end of the day, they're just a price representation vehicle. Unless you have 50,000 shares or whatever the basket is, and it's the authorized participant that decides whether or not they're going to redeem or create those shares. You're just really at the mercy of just trading the price.
Mm-hmm.
And I think, I think if the physical metals markets wants to actually have, and I see this happening, but in order to get more dominance on the physical side of price discovery, you need to start to get institutions to wipe clean of these structured product vehicles, which obviously that's what Wall Street sells, because that's what they can make money on, because it's a fund or a security, and they can only sell funds and securities based off their licenses and all that type of stuff. But if you can get people more into the physical, I think then you'll have a better chance of seeing this sort of separation of this paper market relative to the physical market.
Yeah, no, I agree, and I think that you made the point earlier. I think that I don't know what the leverage is currently, but it's nothing like it was a few years ago, pre-COVID, where we were talking like 200 ounces of paper gold versus every ounce that was in the COMEX. I'm not sure what the numbers are today, but just knowing that leverage number is far lower than it used to be is telling you that we're moving in that direction, and that's another way of saying, look, do we really need that kind of market in order to deliver gold to people? I don't know that we really do. So again, your points, Bob, are well taken. That yes, but the miners need to sell, but as long as there's the thing is, the bigger question is, if these markets are not functioning as real markets, and this has always been the question, then that's why we'll see people moving directly to buying from the producers directly and just bypassing the markets. One of the things I spoke to Caitlin Long this morning or this afternoon, and we did a podcast this afternoon. I haven't published it yet. And one of the things I brought up to her is, think about this. We have a gold futures market, and we have cash settled Bitcoin futures, neither of which we actually need for those markets. Because you can just hedge those with interest rates. But we don't have a functioning coal futures market in the United States, and we actually need coal delivered and coordinated through price and time in order to produce electricity to keep the lights on. And yet we don't have a functional coal futures market in the United States because the consumers just buy it directly from the producers. And I don't know the history in this. And again, if there's anybody in the audience who can, or even Bob can answer this question, why do you think that is? In my mind, it's because they destroyed the coal futures market at some point in manipulation, and everybody just got fed up with the bullshit and went, I'll just buy it directly from Joe over here. He's got a coal mine. I'll just order 500 tons from him a month and get what I need. And I think that it's just weird that we have, futures are supposed to be to help coordinate commodities through price and time and quantity in order to make sure that we have a functioning supply chain so that we can have a modern economy. You can't have a modern economy without functioning commodity futures markets. And yet we don't seem to have that. We have it in gold and we don't need it. And we don't have it in something like coal where we obviously should have it. It just seems weird to me. The only quote I can get is the London coal price, and that doesn't make any sense to me. So just throwing that out there, folks. There's something wrong with the way our capital markets are structured. If this is, as this is an example of just how screwed up everything is, and what these exchanges and what these products and what and years of decades even of just weird manipulation of what should be simple functional markets, and we don't have them.
Well, I mean the metals markets are kind of unique in that they're hoarded type of assets. I mean, besides obviously silver, 60 or 70% of silver is used in industry. But people may not fully understand or appreciate how small the silver market really is. I mean, if you want to throw some money at it, I mean, I'm just looking at the numbers right now, 37.6 million ounces in the registered category in the COMEX. Yeah, we run a very big depository here, and one of the largest private depositories in the country. I could take delivery of all that 37 million ounces tomorrow and stick it in our vault. I mean, it's not that's how small this market is.
Yeah.
And the problem with the paper, and just to let you know, the right now the leverage of the COMEX paper leverage right now in the silver market is roughly around 17-1.
Okay.
And that's basically, it's not trade flows. That's taking the open interest, divide that by the number of ounces outstanding in the registered category back in that open interest. But the trade flows obviously are so much bigger because on a daily basis people are buying and selling and they may be closing out by the end of the day, but it's really the open interest that I think a lot of people watch because that's the stuff that's overnight that people are holding on to as a position. But I think the problem with other futures markets relative to gold and silver is that I think people are institutions aren't incentivized to actually take physical because their charters may not allow them to deal with a physical asset versus a security. And then secondly, the idea of using that metal or collateralizing that metal to open up the value of that metal, it may be a little bit more difficult using, buying physical metal, storing it in a vault versus just buying a futures contract. All of a sudden you have a clearing firm that's going to give you margin against that, and then you get, or a prime broker, and then all of a sudden you have instant leverage or you have the repo market, whatever it may be. But the securities markets are geared really against the physical asset structure, and that's also been a frustrating thing I think for a lot of people in the physical metals market. A lot of the investors out there that are trying to understand, why are these paper flows so dominating? Well, it's leverage. It's like the casino giving somebody a marker. I mean, that's what attracts people to the futures markets. And and if you tighten up those standards or that leverage factor, you're going to see a much tighter market that's probably may not trade nearly as much volume.
Yeah, but would actually properly allow us for better price discovery, which is ultimately what we're all worried about. We're all like trying to figure out why we have bad price discovery in the most important markets in the world. Well, you shouldn't be shocked by this. If they're the most important markets in the world, that means somebody's political ox is being gored, and therefore they're going to try and control the price of it. Like, it's a tautology in that respect. Like, why is the gold and silver market screwed up? Because the gold and silver are important. Why is the oil market screwed up? I would argue today that oil is actually the new gold. It's actually the market they're manipulating far more than gold. I think the gold market is kind of passé at this point, because I honestly think that we're again, going back to the things I was saying earlier about what I think the Fed's incentives are and where I think the Fed's position is. I think at some point we're going to be really shocked when we find out that the Fed actually does want the price of gold to rise. Because this is how the Fed helps us recapitalize in the United States, because we do have to deal with $33 trillion worth of debt. We do have to deal with God knows how much in unfunded liabilities. I don't know what the number is currently, but it's enormous. Say it's $100+ trillion, like on top of the debt itself. You've got all of that to deal with, and you have a pretty small collateral base. And so that, or you have a collateral base that's been locked up behind asset prices that don't make any sense, i.e., $1,900 gold, $20 silver, yada yada yada. So this is where the long-term thing comes. This is where the longer-term strategic thinking comes into play here, and why I'm long-term bullish gold, simply because the Fed has to be long-term bullish gold. Like that's at this point, that's my. And I can finally make an argument for that, as opposed to saying the Fed's going to fight it every tooth and nail up until the end. I think I don't think the Fed cares about gold anymore. I think the Treasury under Yellen cares about the price of oil, because that's inflation. That's the political life of the current trajectory, or at least up until last week, the current trajectory of trying to spend us into oblivion and destroy the country, which is, I think, their goal. Like when we stop asking, we stop wondering whether these people are just incompetent, and we start thinking of them as Joker characters and vandals. Like the world becomes a lot more explanatory. Just like Occam's razor takes over and, oh no, they're not stupid, they're just evil. It's not tough. They're not stupid, they're traitors. And when you stop, and I mean traitors, Traitor, not Trader. Like that's when all of this stuff becomes so much more explanatory. And I don't want to, I'm not necessarily trying to move the conversation there, but it's where I think where we have to start thinking about what we're seeing in the markets, and then how that's reflected in changes in policy and how people are reacting to these things. And I just don't think these people are unmotivated. I think they've come out and made it abundantly clear. They've ripped the mask off. They've drawn back the curtain, and they've showed us, like, we're sinister. We hate you. And oh, by the way, this is what we're gonna do to you. And we don't care, because we don't have to care. We're in charge. Okay, you're feeling froggy. Take that leap. The bigger question then is, when the major power brokers of the world start fighting amongst themselves, watch out, because that's where I think we are, and that's when things get very interesting, and that's when we have these kinds of moments where the rules have changed and nobody's really quite noticed it yet. And then you see that reflected in the way gold and silver are trading, the way oil is being traded, the way, even to a lesser extent, the way copper trades, and then of course the bond markets and everything else. And I think I've been taking that tack now for well over 2 years, and I can tell you that it's almost like it's become almost, oh, this is what's going to happen next, because this is the only move they have left on the board. When you're locked into a path and you're in the end game state of a game of chess, for example, or whatever, you don't have a whole lot of real moves left on the board. You got plenty of moves, but none of them are any good. And I think that's kind of it's one metaphor to use, and this is the way it's playing out.
And I think to continue with that metaphor, it's like in this chess game, especially when we're looking at the volatility and the influence of like geopolitical situations, as we were saying, the importance of oil versus that of precious metals. I think that when we're looking at precious metals, the game is set with very matched players. And so we're going to see a stagnated field even in the fluctuation of geopolitical manners, meaning we might see a linear response in that sense, where either when we see Russian and the Russian-Ukrainian type situation, we knew the reaction gold would represent, but we didn't know the nonlinear effect that oil would represent. And so here's where I say the match isn't well set, where the oil market has a clear advantage in a certain area, and the geopolitical situation has a lot more tendencies to interlay it, right? And hence why we had this informal price control attempt with our SPR release.
You got it. Absolutely. Absolutely. Like, at the end of the day, it's like my friend Alex Craner reminded me, or honestly taught me by saying this. It's all about collateral, folks. Europe doesn't have any. They tried to go out into the world and get it, and they can't get it. They have no energy. They have no collateral for their debt, because oil is oil, coal, energy sources are the collateral on which their economies run. Because without that as the collateral, then they don't have a functioning bond market. And if they don't have a functioning bond market, they don't have a functioning currency. Without a functioning currency, they can't have a functioning economy to express the value of that collateral through the labor and the taxing ability of local governments. The labor that produces the wealth, and then the taxing authority and the taxing capacity of the governments. And that is ultimately, that's why you are absolutely correct. That's why oil is so ungodly important in this environment. And notice who's trying to tell us, to shame us in getting off of hydrocarbons. The people who don't have any. Like and they want to shame us into, walking into the world owing a carbon debt to the planet. It's like Catholic original sin doctrine as applied to, oil. Like it's pure insanity when you stop to think of it in those terms. It is absolutely pure and utter. It's truly insane. But some people have actually fallen for it, and that is even more insane.
Yeah, and Tom, I would say to you is that you're talking about maybe two different groups. You're talking about policymakers who basically are pushing through bills, laws around the world
Right.
based upon ideologies. But you've also were talking a little bit about basically the powers that move things.
Mm-hmm.
And I would put forth that most individuals who invest or basically play positions are agnostic. You know, they're not about like gold, they're not about silver, they're not about anything about a particular commodity per se. They're agnostic. They're opportunistic. So
there are many opportunistic
and
players.
being one of those
Agreed.
persons, being a wonderfully opportunistic trader, I am wonderfully agnostic, which means I want to play and I'm looking for liquidity. You know, so I look for something I can play that's liquid, and I look for positions I can move in and out of easily.
Sure.
So when we're talking about and you're looking at basically how things move, kind of understand, at least from my position, I think the vast majority of the movements are agnostic and they're opportunistic.
No, I do not believe that. I believe most of the players are
Really?
opportunistic and agnostic, but I do not believe they're the ones moving the markets, my friend.
Oh no!
No, I don't believe that. I don't believe dude, go look at it. If you look at a week, I'm sorry, hold on.
Go ahead.
I just want to say, if you go look at a weekly price for oil for 2023, you will see a price cap, a hard price cap. I have never seen a more manipulated price chart than the weekly chart of oil from 87, the hard price cap at $87 a barrel. For months on end, I saw every time oil got anywhere close to $87, one bar weekly reversal down, slam it on Friday afternoon in the last 3 hours.
No, I don't disagree with you. Yeah. I don't disagree with the least. Right. I'm sorry, my mistake.
Okay.
I will rephrase. No problem. I would say that for persons like myself who are agnostic,
sure,
we are looking for liquidity.
Of course.
That's the end game.
Agreed.
We're not connected to oil. We're not connected to gold. We're not connected to palladium. All we look to see is when we can play those positions and make some money off of it.
Of course.
But mind you, I don't disagree, and I'm sorry, I do not disagree with you.
Okay, so what I'm trying to do, Joseph, is I'm trying to illuminate for you the incentives of the people who are moving these markets in such a way that you can have a tradable edge. Because if you understand the geopolitical ramifications of what's trying to be put in place and what the incentives are and what the goals of those people are, you now have you have the most tradable edge you've ever had in your entire life. Because you know what they're going to try and do next. Correct. That is the key.
Yeah, exactly. And because I mostly day trade and I trade. And I trade across the whole spectrum of equities.
Sure.
So yeah, as the way I'm able to make money is by looking and watching what the movements are in the market. And that means I will look to see where things are moving. And I understand that there are a lot of powers that are out there that are moving the markets around. Sometimes they're just little lemmings, and sometimes there are what people call market makers.
Yes.
You know, and sometimes those are countries.
So let me ask you a question. So Joseph, just out of curiosity, I don't mean to use this term pejoratively. I actually not. But are you a Momo monkey?
What is that?
That's a momentum monkey. That's a guy who only trades momentum. If the market's moving in this direction, I'm taking the momentum and I'm running with it until the trend ends, and then I'm going to take the momentum in the other direction.
No, I'm not.
Really?
I'm a catalyst player.
Okay.
I look at every day as being in a new market. Mm-hmm. I look at every single day as being a unique thing, and every time the session starts, I have no freaking idea where we are going until I see how it's unraveling and it's playing out. As far as I'm concerned, the way I play it, I consider basically the beginning of the session is basically like a game of poker, and I'm getting dealt my hand, and I'm seeing what's on the table, and I'm eyeing all the plays. That's how I do it.
Okay,
because
fair enough.
Anything can throw me for a loop at any moment. You never know what's going to happen from moment to moment in the news or from any sort of catalyst out there that can just throw your whole game plan for a loop. So I look at every single day as unique.
Interesting. I have not. I don't day trade, and as a matter of fact, I don't even keep. I'll be on this for full disclosure. I don't keep anything in the capital markets whatsoever. And I do so because I can't do what you just described. Me personally, as a human being, I'm not capable of it. I'm not capable of doing that. And I know myself well enough, having traded badly many times in my life, getting my ass kicked, to know that as a human being, I don't have that. I don't have that capability. So what I have to do is I have to use the strengths that I have as a person to analyze things from time frames and in ways that make sense to me, that tell me stories that make sense. And so that's why I do what I do the way I do it, and for better or for worse, and whether that's of value to you or to anybody like you is
it's just a different way of doing movements.
Sure.
I mean, there's no right way to say. It's whatever works for each individual.
Yep.
All I'm saying is that for me, every morning I am looking and I'm double checking earnings results, looking at the analyst updates, looking at news releases, looking at what's coming out, the latest things from the FDA for biotech, for example. And I'm looking at all the latest, the top news, like your big macros, what's going on in the markets, looking at the index movements. And that's how I play my day out. I usually, for me, excluding my long book, if I'm doing my trades for the day, I start my trades for the day. I might move it out for the day, but at the end of the day, I've closed almost everything.
Right.
So that I always kind of say, start each day fresh. But that works for me. And I have the time to do that because, well, that's how I make money.
Sure, fair enough.
And so, whereas
more
other
power to
people
you.
like I said, but that's my way. For other people who swing or do longer trades, and it works for them, that's amazing. I just know that for myself, I like to sleep at night, and so I basically
fair. It's a fair way to look at this, man. Stay in the moment, be a hockey goalie. Don't care about the puck you just let in or the stick you save you just made. Only look at what's the next puck that's coming at you.
Yeah, that's for me. That means that basically at the end of the session, I can go out and have dinner. I can go out and enjoy the day, and I don't have to think about anything other than just enjoying those moments.
Yeah,
because
good for you.
There's nothing open. But again, that works for me, and that's not for everybody. But I was just interjecting really because when you and Bob were talking, I just wanted to, and I'm sorry, I really had just wanted to interject that there are those of us out there who are just opportunistic agnostics when we play these positions. And we don't have like long-term skin in the game on the ideology of gold or palladium or silver. But we're looking at how we can get in and out liquidity. And I guess for someone like myself, that's why physical materials don't always necessarily have a great deal of attraction.
Okay,
movement.
But what I will say to you is this. What I will say to you is this. If all you're doing is playing the game on a daily basis and you're not stacking real world assets with your profit, and I mean this sincerely, and you ask yourself, what are the things that are of value? What are the things that are because there's going to come a day when you're going to not want to live like that anymore. Trust me on this one. You sound young. I'm 55.
I'm not young.
Okay. Well, cool. What I'm going to say is
I'm the opposite of young.
Oh, cool. But that's fine. Okay. Well, then I'm wrong about that. What I would say is, and it's something that Chris Sullivan and I talked about when we did a podcast together a while ago. He's like, look, at the end of the day, I obtain dollars in order to obtain things that have value to me. That be it my home or my family or the physical assets that I believe are of wealth. And I remind people on a regular basis is that is your ultimate. That's winning. Having more dollars in your bank account is not necessarily winning if you're not looking at the long-term health of what the dollar is. And again, I'm not arguing against the dollar because right now I'm a dollar bull. Like, I think people should be holding dollars right now because, well, they're appreciating in value against real assets. And real assets are the things you can touch in the real world. And that's where real wealth is. It's that I've said this many times in podcasts. It's like it's that moment in the first episode of Yellowstone when Kevin Costner says to his lawyer son Jamie, and Jamie says, "Look, I was saying no to get leverage over these guys about selling part of the ranch," and Costner looks at him and says, "Look, leverage is knowing that if you had all the money in the world, the ranch is what you would buy." Like, that is a powerful statement about what wealth is versus what it's this paper wealth and this real wealth. And all I would say to you is, if you're making money every day doing the thing and you're doing it and you're doing it successfully, what are you saving that? Why are you doing that other than to have the day? There comes a point where, you do have posterity and you are trying to, in some way, what are you trying to do in order to make the world, try to make your community or whatever a better place? And that's part of why it is that we should be here doing what we do, because otherwise, why are we acting? Just be cognizant of that. That's
No. I thoroughly agree. My belief is that money not put to work for good purposes is money that's being wasted. And so for myself, there's a certain amount of wealth I use for my own personal enrichment, my own, my family. But also how do I say this? I always divert a certain percentage of my gains to do better around the world.
There you go.
To make this place a better place.
There you go.
Which is why I normally highlight. I know you don't know who the hell I am.
It doesn't matter.
That's okay. But I normally highlight at any given month several key causes.
Sure.
That probably need attention. I'm always giving away amount of my gains to different needs because, in my opinion, it's not enough to do well and to get your wins.
Right.
You have to put that win into good use.
There you go.
And if that's not being done, then for as far as I'm concerned, the question is, why are you doing it?
Yeah, there you go. I would say, and the thing I always like to bring these discussions back to is what's happening at the macro level. As going back to the things that were said earlier, globalization is ending, regionalization is happening, the political instability is rising, and that means that communities themselves have been hollowed out. And when I make it sounds silly, right? But when I go to spend money, on food, I am overjoyed now that there's a local butcher shop in my town, as opposed to having to go to the chain supermarket to buy my steaks. I now can go to the local butcher shop, buy a better quality steak, and they make some amazing sausage and some other things, and bring that home. And if I've had to pay an extra $1 or $2 a pound, that's fine. But the money stays locally in my community, and helps to.
And building on that, Tom, is why I support farmers markets. Because you'll have sometimes ranchers there, you'll have dairy farms there, you'll have produce there, you'll have people who basically put up, preserves, up cheeses.
You used to have me there, Joseph, because you might not know this, but I used to run a goat dairy out of my home. I used to go to the farmer's market. We did this for 5 years. My wife and myself, we ran a goat dairy for 5 years, and I felt it was like community service. We lost money doing it, but we did it. I mean, the tax write-off was nice, but we lost money doing it. But and we spent a lot of time doing it. But we ran a goat dairy for the exact purpose of this is our. I'm not good at many other things about community building, but I could do that. And so, I know exactly that. I know all those people, and I know how hard the local farmers work. And I can tell you, nothing gets me fucking angrier than anything else than listening to some PETA, jackass telling me that meat is murder. I go fuck yourself, and that animals are slaves. Go fuck yourself. You have no idea how hard I worked to keep my goats alive for 13 years. I ran when I was running a goat farm. Like, it was crazy. Like we were slaves to our animals. We worked for them, not the other way around. And people who've never farmed have no idea about these things. So yeah, when I talk about these things this way, it's because I've lived it, and it's what drives so much of what I do and the analysis that I try to put forth is that it's about making this. It's about reversing the shit that these people have put in front of us and the unbelievable level of corruption that exists, and it has to end. And I will be happy, even with a bit of rose-colored glasses, happy to latch on to anybody who's trying to reverse that. It will start reversing that, and even if it means championing the Fed while they pursue their own interests, which happen to dovetail with my interests. I'm on Team Fed for a little while, but I'm not going to be on Team Fed forever because I'm going to be looking at them when we get done with when they get done getting rid of the worst bad, which is those goddamn Eurotrash commies. And that's my that. Okay, I'll end there, and we'll move on to the next. We'll move on to the let Bob or somebody else go on. But thank you for bringing that up, Joseph. It's a very interesting perspective on this, and more power to you, bud.
Yeah, that was great. I know Phil had his hand up before Joseph went and asked his question. So Phil, if you got something, feel free to butt in, man.
No, move on.
All right. Well, I did see Jim got up here on the stage. So welcome, Jim. Do you got anything for us? I know we've been kind of talking a little bit about precious metals. We got a little off topic for a sec, but yeah, Jim, go for it, man.
Hi, good evening, folks. Yeah, metals, maybe we put in a bottom here in the last, let's say, 5 trading days, and the gold we're up like about $50, and silver's $1, a little more than $1 off its lows a little bit, and hopefully we can keep that up. The dollar has come off a little bit in tandem with those metals reversing a little bit, and unfortunately, I hate to say, there might be a little bit of a risk capital attraction into the metals, into gold especially, because of this horrific stuff that's happening in the Middle East. It's just absolutely terrible. But I'll go back and I'll stand by and come in when I want. Thanks.
I don't hug the microphone, but I also hate dead air. So if anybody else wants to comment on what Jim said, I agree, Jim. I think we may have a chance to put in the bottom here. We'll see. It depends on how we close this week.
Yeah, so I just wanted to kind of answer a question you had, Tom, about the coal market and why they don't have a futures market. I don't know this exactly for sure in the coal market, but when I worked in the steel industry, I was a steel analyst. They always tried to create a futures market for steel. Like they were at every convention and stuff, and it was always kind of laughed off. And one of the issues is, although it sounds like a fungible commodity that could be easily exchanged and used to hedge, it's really not. There's tons of different grades, tons of different things. And I know that's one because we would often look at coal too because it's related, thermal coal and coking coal. There's a lot of different grades of coal and a lot of different BTUs.
Mm-hmm.
And what happens, just like in the steel industry, is it ends up being, I think, a contract spot market more so than anything. There's also a tremendous amount of inertia that goes into these things as well, where people don't want to switch over. So those are some of the things that like kind of doomed the steel futures market. It was around for like 10 years before I even got in the industry, and it hadn't caught on yet. I know the LME had a few contracts for like billet and hot roll coil,
right?
And, yeah, stuff like that. But you know, it's a different industry. I mean, there's all these different people who treat it, move it, all that stuff, and there's all these traders who specialize in spot when people need it, and a lot of it's contracted as well. So,
yeah. Oh, thank you, and I appreciate that as a comment. My thought on this is, well, there's a ton of different grades of oils out there, and somehow we are able to price everything for the most part, we price everything as a discount or a premium to Brent crude, and you just know the oil market that way. And we have the Brent crude contract, which is a light sweet contract. We have the WTI contract, which is a light sweet crude contract, and then you have the Shanghai contract, which is the medium sour contract. And yet somehow we're able to trade oil that way based on people speculating on oil. I get it. I know that the coal market is different. I know the steel. I would never expect the steel market to be able to hold a functioning futures market, because I worked in metal finishing for a while. I worked in metallurgy as when I was a chemist.
So you
So
were just
yeah,
somewhere.
knowing what little I know about that industry, I'm like, yeah, that makes perfect sense that there wouldn't be
Yeah.
a good steel futures industry, because it's just there's literally like 500 industries in there. There's not one. You know what I mean? But the coal market isn't that. I mean, I understand the BTU value of various grades of coal is different, but it's still it seems like, really we don't have that it would be that different that we wouldn't have a functioning futures market. I just find coal I find odd, because it's an energy thing and it's a primary commodity necessary to run an economy. Steel is a finished product, as it were, right? We have functioning aluminum futures, and there's a bunch of different aluminum out there, right? There's a functioning nickel market, and nickel is used in a variety of different ways, and we have functioning markets for all these other metals, but we somehow don't have it for certain ones, and I just wonder, I still wonder why that is, right? So
yeah, I wouldn't expect one now either, because it's kind of a declining industry, at least here in the USA. I think more and more nat gas plants were built. Well, 20 more were built this year. A lot of those are replacing old coal plants. But the one thing I wanted to say about gold and silver a little bit, they've actually held up better than I would have thought, given where real rates are, and the DXY has gone. They've actually done fairly well. Yeah. The only reason I can explain that like that is I think the central bank buying has been so intense, particularly by China. I think they just did their 11th straight month of buys at 28.8 tons. That was over the weekend that news broke.
Ready for one that'll bake your noodle? Ready? You know who entered the gold market for real in the last 6 months? Poland.
Yeah.
They went from buying 3 tons a month to 20 tons a month.
Yeah. Poland has been very big, and they've been doing size. The one I still can't explain, I think they were buying for someone else, because the size of it was that Singapore buy where they did 30 tons, because that's a tiny economy. It's 1/17 the size of like China, I think. So it's just a vast amount of gold for one central bank to buy. I had a suspicion they were buying on behalf of China or India, but obviously you can never prove that.
I don't know. The Monetary Authority of Singapore is a very interesting central bank. They're closest thing to an algorithmic central bank, like an algorithmic stable coin, I think, on the market. And they're very powerful, and they're a very important clearinghouse for offshore clearing for the yuan. Very important. And Singapore is, I would not be surprised. They've been building an infrastructure, a gold infrastructure in Singapore for 15 years. In order to be able to handle those flows. I think the gold market, what I was saying earlier about gold regionalizing, I think Singapore is getting ahead of that in order to, is part of that process. And I think Singapore, it's been dubbed the Zurich of Asia or whatever. And I think that's very real. And they also have they've been trying to, I'm out of date on this, because I used to study Singapore in Southeast Asia about a decade ago. I spent a lot of time working in that market, because I was working with a guy out of Vietnam, and so I learned a lot about those markets then. And they also want to be the Henry hub of natural gas prices in the region as well, and heating oil prices. And I don't know that they've achieved that. I haven't kept up with it, to be honest with you. But Singapore is an incredibly important market for what the future of the global monetary system will look like. So I am not surprised that Singapore is buying gold.
I think it may be important just to distinguish on Singapore. The central banks have been obviously the big buyers, but in terms of the retail market, investment market, the Singapore has been pretty much, besides a few events, has been pretty much a dead market. At least with regard to volumes and flows, because the bids out there are not nearly as strong as the U.S. market, at least from the smaller coin and bar market. And maybe on, obviously, like you said, the central bank side, they're buying a lot of it, and that's been very supportive, I think, of the gold market. The concern, I think, that people in the industry have is that what happens if the central banks just decide to step back from the market if they think the prices would go lower, so they can just pick it up at a lower price. Not necessarily anything nefarious, but just from an economic standpoint. And that's something I think everyone's watching for, to see if they do slow down those purchases.
Well, again, Bob, if we're moving into an age where having gold collateral available to settle, trade deficits and trade surpluses with, and if people start if demanding gold in a certain level as a trust issue because they're beginning to distrust each other's, they have to, if they're replacing the dollar, right, in certain aspects of their trade, then they're going to have something else undergirding their currency. So what everybody is doing now is this reason central banks are buying gold is because they're trying to shore up the value of their currencies in the face of a dollar liquidity shortage globally. It actually makes perfect sense. The Fed's been pulling back on global dollar liquidity now for over 2 years, since June of 2021. And the response to that has been central bank buying of gold in order to keep local currencies from collapsing and local bond markets from collapsing, because, well, we're buying gold and we're trying to shore up the hard assets on our central bank balance sheets and to shore up our forex reserves. It makes perfect sense to hedge our dollar risk. So, that's why gold keeps getting hit. Every time gold gets hit, it keeps getting strong central bank buying and any dips whatsoever. So I think that trend I don't think that trend's going to end anytime soon. I think, again, I've always distrusted. I mean, this goes back 20 years. I've always distrusted the idea, and this is before I was a public commentator. This is when I was one of the people. I would have been one of the people in the audience, right? Because I was that person for a long, long time. And what I would have said was, oh God, what was I saying? I hate it when I lose my
the audience for a long time.
Yeah, it wasn't just that. It was that I've always distrusted the argument about real interest rates and gold they're inversely correlated. They are when there's no stress to the system.
I agree with that completely. I think there's really three factors. It's real rates, the dollar, and fear.
Mm-hmm. Mm-hmm.
And
exactly.
The two earlier factors kind of matter in the moderate scenario. That's what they normally trade off of. But you see something like a Ukraine war go off. I actually kind of expected it for this recent one, given the history of that people. But it got contained very quickly. Sure. And they weren't as nervous. So no one needed to panic buy gold. But it could have happened. And we're seeing more and more of those events.
Yep. Yeah, no. Again, when everything is operating within one sigma of the norm, right? Then relationships hold, right? And when but what happens when the rules of the norm change? That's one thing. That's one factor. And then what happens when we just move outside of the one sigma event, right? I think the extreme dollar strength that we've seen over the last couple of months is indicative of an incipient sovereign debt crisis. And that's part of the reason why, and when things like that begin to happen, it's no different than in 2011 when Bear Stearns imploded, right? Gold went from 1033, hit a high at 1033 over the weekend. Bear Stearns imploded and then gold got shellacked for the next 6 months into the low of 681 after Lehman Brothers. But then once everybody realized that, that we were into a different regime. Bernanke was talking QE, went to the zero bound, TARP went through, blah, 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 blah. Gold went from 681 to 1911 inside of 2.5 years. And it only was arrested when the central banks all came together and said, okay, we're going to coordinate monetary policy, open up slush funds in each other's currencies, and liquefy the global markets. That is what broke the gold bull market. Okay? It was the 500. It was the announcement of a 500 billion. I was there. I was in the market that day. I lost my ass that day because I'd misread. Because at the time I was a novice and I was a neophyte, and I lost my ass. Right, and that announcement, I misread that announcement completely, and I know why I misread that announcement completely, because I was a gold bug. That's why, and that taught me a very powerful, painful, and expensive lesson. When policy normalizes, when policy is implemented to restore faith in the system on the part of the dominant players in the system, that's when the trend ends. And that response by the central banks was the exact thing they had to do to maintain some semblance of control. And then we had a lost decade. Effectively, then we had a lost half decade in gold. Gold hits the bottom of 1056 in December of 2015. And then once everybody realizes that QE has got to end eventually, all of this, and there's a political change in the political winds in the United States. And even Yellen was talking about finally ending QE and beginning to raise rates, even though she put it off for another year because she's a fucking globalist. That's when gold came off the bottom. The gold bull market really did start, and the bottom happened then, and the bull market started. The current bull market started then, and it's now 8 years old. And all it did was retrace back to the 2011 high, but that, or just slightly over it.
Well, a lot less though with inflation. Keep that.
With a lot less with inflation. Agreed. No argument. So now the question is, gold will always catch up eventually, and will. So where are we now? I think we're not at the 681 level, but we're at the weeks after Bear Stearns imploded.
Yeah, and my big long thesis on gold too is the fact that the dollar reserve isn't going to be what it was before. We might have multiple reserves, but in a world where no one trusts each other, the reserve that is no counterparty risk becomes more valuable, even to the central banks. And you're seeing that. That's one of the reasons China's doing what they're doing. The rules changed when they did that to Russia with their SDR and their small amount of USD reserves and their Euro reserves. They got taken. They'll probably be given to Ukraine at the end of the day, or given back to the United States via Ukraine, but to parties here. But that was a rule change, and the whole world was watching. So expect behavior to change.
No, we made a mockery of the idea of the concept of foreign exchange reserves by seizing Russia's offshore foreign assets. We changed the rules of the game, and it was the biggest mistake we could have ever made. Because it was, and I will be honest with you, watching this the way I've watched it for as long as I have, to me, that felt like a desperation move. It was supposed to be a knockout blow, but Putin knew it was coming, because we already signaled that we were willing to do that during the oil devaluation of 2014, which was the first time we tried to overthrow Putin through what is popularized as an economic hitman operation. Okay, take the price of oil from 125 down to $25 a barrel over a 4-month period. Take the ruble, force Putin to devalue the ruble, which no one expected him to do, but he did. And then he started the process, and then target their corporate bond rollovers, and make that impossible, which is what we did during that period of time. It made it impossible for Rosneft and Gazprom to roll over their dollar-denominated debt. Remember, because we had put sanctions on them over Crimea through the Magnitsky Act because of this. And this was meant as a double knockout blow that was supposed to destroy Russia. And if you go back and you look at headlines from that period, you will see all the usual suspect neoconservatives in the American, British, and Western press all say the same thing. This was going to end. The ruble is toast. The Russians are going to fall. Putin's going to be thrown out of power. All the rest of it. Putin survived that. He knew what their response was going to be when he invaded Ukraine. He knew exactly what they were going to do. And I'll be honest with you, the person I'm almost wondering if he didn't dangle that money out there as an opportunity and say, look, here it is. Go ahead and take that $300 billion. We'll make it back in oil prices, and we're not worried about it. We can make that money back. But you do that, and it'll be the most expensive $300 billion you ever stole from us, because it will cost you $30 trillion over the next 20 years. Because now the entire world is looking like, well, if they can do that to Russia, they can do it to us.
Hey, Tom,
and that's what's changing everything.
I wanted to ask you another question, kind of on topic, but
sure.
The you watch the tick flows, and I'm guilty of now. I work in banking, but I don't watch that closely enough. But one of the things that I have a suspicion is going on is that a lot of people are letting their longer treasury holdings roll off, and they're replacing them when they do with a lot of short, and that's kind of the plan a lot of them are taking right now.
Oh, yeah.
And this is a huge problem, and they might not go back into the treasury market later. So although it doesn't look fatal from a foreign reserve perspective yet on the U.S. dollar, I suspect a lot of the tenors they're holding is getting much, much shorter, and then they have optionality with what they want to do with that stuff as it matures.
What I can say to you is that process has been in motion since 2009. The average maturity on foreign held debt is like 5.5 years. It may even be less than that now. It was 10 years or so. It's now like 5.5. I haven't updated myself on what those numbers are, but I remember having this conversation with a patron who was a hedge fund manager and bond trader, and he asked me. We were talking about this about 18 months ago. Might have been 2 years ago, to be honest with you. It was a while ago. He's like, "That's the time bomb. We have this amount of time left before." They pull the plug on us. Which is, when you think of it in those terms, then what a shock that Powell is trying to end the Fed put and trying to raise interest. He's raising interest rates to make America investable again. I joked earlier in the year about the manipulation of oil market, saying, forget MAGA, we need Moya, make oil investable again. Oil volatility has been off the charts, guys. It's tripled in the last 18 months since the Russia-Ukraine war. And it's not because of the Russia-Ukraine war. It's because of the insane desire to starve Russia of money, of oil export revenue, that they have tripled the volatility in oil. The amount of vol washing that's happening of the small specks in oil is insane. Because, the more you wash the small players out of the market with, I have a very simple volatility measure, and it's not a standard one, which is just to take the weekly, take the range over a particular time period and divide it by the price. Okay, so the range for the week, and I use this mostly for a weekly chart. Do you understand that oil trades on average 7% a week from high to low? 7%, guys. Joseph, you're talking about wanting some trades to try and make some money on them. 7%, dude, from high to low on a weekly basis. Okay. Now, of course, that number goes up and down and fluctuates with price, right? The price goes up by 15%. That number is going to drop by 15%. But it gives you an idea. In this price regime between $70 and $90 a barrel, oil moves 7% a week. Bitcoin doesn't move 7% a week. Okay? Oil's volatility is it's trading like a penny stock. Okay? It's truly insane. And the only and it's concomitant, that volatility and that rise in volatility is concomitant in time with the desire to bankrupt Russia after Ukraine started. Before the same thing happened in the Dow after Trump was elected, by the way. The volatility in the Dow tripled. I had to change the way I do my quantitative analysis of setting pot odds of potential breaks of previous highs and lows every week. I do a kind of non-standard quantitative style mix of quantitative and qualitative analysis. My patrons know exactly what I'm talking about. I had to change my data set on the Dow. Usually I just aggregate 254 weeks worth of data and then run my statistics based on that, my back test based on that. I had to literally go back and say, okay, from the moment Trump was elected, and I had to run the Dow for these 50 weeks and then keep running it since then, because the volatility on the Dow literally tripled, and it so thoroughly skewed my data, which is that model is most predictive and most actionable when under normal volatility. But if the volatility of the data set has a clear break point in it, then you have to ditch the older data, right? Because one is operating under a 1 sigma. What is 1 sigma into this time period is 3 sigma time period, and those two don't mix very well, and you get very distorted data, and then you get less actionable.
Yes. So in other words, we're operating in
probabilities, right?
We're operating in a new regime, is really what you're saying in terms of volatility on oil. But one thing I wanted to also point out, and this a lot of times these things change, and then people don't keep track of that we're in a new regime. And one thing that really changed even after the Russia thing, we released the SPR. I always thought the SPR was like national defense, but now I'm realizing more and more it was a sort of Damocles above traders. This high you shall go and no higher sort of thing. And now half of it's gone. So a lot of that threat is gone with it. And some of the most important oil is gone too, the medium stuff. So it's a lot of lighter, sweeter stuff left, and we can't necessarily use that in all the refineries. And, that is a big change that's gone on.
Well, here's another thing. Remember, let's go all the way back. Let's set the Wayback Machine to 2008. When Obama, or 2009, when Obama first started making noises about opening up Swiss banking privacy, and he threatened the Swiss. Eventually, in 2010, UBS opened their books up, but he threatened them with Swiss expulsion. Were you guys following Jim Sinclair back then when he said this is the equivalent of going nuclear? Threatening somebody with Swift expulsion is the nuclear option, and when you go nuclear, you have no other option beyond nuclear. Because what if UBS had stood up to them and said, no, go ahead, kick us out of Swift? It wasn't likely, but what if they had? What if somebody had stood up to them and said, go ahead, kick me out of Swift? 2 years later, we did that. In December of 2012, we did this to Iran, and Iran survived. So the nuclear option from a financial perspective was thrown at Iran, and Iran survived.
And didn't they use gold in part to help survive? I remember that was moving prices.
Oh, no. It was even better than that, dudes. Right after that, Erdogan in Turkey remonetizes gold as a tier 1 banking reserve for the entire Turkish banking system. Uses the Turkish banking system to launder gold sales of Iranian oil through Turkish banks. That's why when you go look at Turkey's gold reserves, there's a big, the World Gold Council's website or spreadsheet, there's a big asterisk next to Turkey, because it's not just Turkey's central bank reserves, it's a sum total of the Turkish banking system. But that was done, that's how Iran survived. They were selling their oil for gold using the Turks as an intermediary. Which is why, by the way, when the coup against Erdogan occurred, and Erdogan survived, and he got on his iPhone from a bunker somewhere. By the way, he was in Iran when that happened, and it's why after he survived that coup and he went to Moscow, he hugged Putin, because Putin tipped him off that he was about to be overthrown. They got him out of Ankara, and they moved him into a bunker in Iran. And that's when he put out the call to the military to say, step up, stand up to these people and put this down. I'm alive. Everything's fine. I'm in control.
Tom, you believe that coup was real?
Yes. I believe that coup was set up. I believe that coup was run out of Incirlik by the United States.
So you don't think it was Erdogan trying to purge the government of his competition?
I think I think that's what he finally did after that. But there's very credible evidence that was being run that was run by us out of Incirlik, because he refused, because he was trying to make He was starting to make noise about rapprochement with Syria, with Assad. That was very clear. He was off the reservation. I covered this very extensively in my blog. No one was reading me at this point in time back in 2016, 2017 when I was writing about this stuff. But this was clearly everything that was happening at the time. I spent like most of that year covering Syria in detail and the moves therein. And yeah, I'm pretty confident of that analysis.
So what would the reapproachment with Assad and Syria be? Because they do have the territorial disputes. For example,
they do.
A little piece of,
But it was Erdogan was willing to. Erdogan was beginning to get cold feet about going any further, and he was and then remember, this is after the Su-24 incident that was a clear attempt to get Russia and Turkey into a war. So that then we can bring NATO in through an Article 5 thing, blah, 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 blah. Remember that? Okay, that was yet another attempted false flag operation. The details on all of this at the moment are a little hazy. They're in the before time now. They're 7 years old now. I have to go back 6, 7 years old. I have to go back over this stuff. What was actually happening in the moment at that time. But that was the upshoot. Erdogan was walking off the reservation at that point, okay, of the NATO reservation. He had been promised all of Idlib and most of northern Syria. It was only well after that he made his move across the border, and only did he make that move across the border after a lot of wrangling back and forth. He still controls that area, 30 miles, that 30 kilometers of the northern border of Syria. To this day, but he's been fighting the United States over backing the SDF Kurds east of the Euphrates River. He's extremely angry about that, and has been for a long time. And then today, he comes out along with Saudi Arabia and basically backs the Palestinians. Like, we're seeing the Arabs in over Israel. We're seeing them coming together. But at the same time, like, the situation with Hamas is very complicated, and I don't have a good handle on what I think is actually going on yet. So I don't want to comment on that further, simply because I haven't come to I have like 5 different scenarios in my head that could be going on here, and I'm waiting to see how more of the reactions to this shake out. Okay, because we don't have a good handle yet as to what's going on here. We're still in the fog of war on this. So it's kind of like the Nord Stream 2 pipeline bombing. I had my initial thoughts on it, and I was wrong. And within a week, I came to the conclusion it was the Brits and the Poles that basically did it with technical help from the Americans. And that I still believe that is correct, but that took me 2 weeks. Took myself and Alex Craner about 2 weeks to put together.
Hey, quick question for you. 2 questions. What
Sure.
was your initial wrong assumption there that you corrected later? And then the other thing I want to say is actually a comment. I'm kind of withholding judgment on the whole Israeli thing until I see the second act, because I think Hamas expects what's about to happen next. Mm-hmm. So I'm curious what happens when Israel does what they must do.
I think, guys, I can believe that Netanyahu allowed this attack to happen simultaneously. I can see that, given where we are with the turmoil at the top of the American political system, we have a weak president and no Speaker of the House, right? That Hamas / Iran, who's denying all this. Iran is the wild card here, and this, again, take all this with a grain of salt. Salt all this to taste, guys, because I don't have a good handle on this yet. But these are 2 of the scenarios that I've got in my head. And Iran saw the opportunity to force the United States to choose between backing Ukraine or backing Israel. And either way, this is bad for Israel, because this is the worst. If they do what they think they have to do, or what Netanyahu wants to do, it will unite the Arabs in a way that they haven't been since Lawrence of Arabia. But Tom, it'll be against the Brits this time, not against British interests, as opposed to in their favor.
Tom, if Netanyahu is ousted as the PM, in the next couple of months, would you change your view that he was aware and then let the attacks happen?
He's centralized power. I don't think that's going to happen.
No, but if it were to happen.
If he does, yeah, if that happens, which I put a low order of probability on at this point. I put
you said maybe, kind of, right? You're not saying he knew about it for sure. You could believe that, right? Yeah.
Yeah, I'm saying I could believe simultaneously that he was warned or that he knew and wanted to, and invited this in order to radicalize the American political situation in his favor, because because the whole Ukraine project was starting to fall apart. Netanyahu and Israel are, of course, a British government project still. Never separate the Brits out of this calculus. Okay, the whole neoconservative ideology starts with the British and been grafted onto American conservatives. Okay, that was Bill Buckley's job back in the 50s, folks. Who was a CIA asset, by the way, on top of everything else. So, like, this is where it starts to get. I can believe that, and believe that Iran saw an opportunity to force the United States into a Hobson's choice between one project versus the other. And I can also see the Brits and Europe happy that we're going to go whole hog and like Rambo with that jockstrap into either one, because that's what we've been holding off doing. It's very clear to me over the last year that the Department of Defense has no desire to go to war with Russia. Otherwise, NATO would already officially be involved in the war in Ukraine. Okay? The NATO summit in July in Vilnius was supposed to be the crowning moment where we put Ukraine on a path to NATO membership, which forced Putin's hand to, I don't know, nuke Kiev or something, and then we can turn him into Hitler, Mark II. That was the moment. That was the gambit. And that didn't happen. And why didn't that happen? Ben Wallace's political career ended. He was supposed to take over as head of NATO. We were going to put the British foreign minister in charge of NATO, a rabid neoconservative in charge of NATO. This is like manna from heaven for globalists. This is like manna from heaven for British foreign policy. We've got a war in Ukraine. We've got Russia vilified, and now we're going to be in charge of NATO policy. And Biden, of all people, was the one who said no to that and backed Stoltenberg to stay on for another year. And that came because it was very obvious at that point in my mind that that came from the Joint Chiefs of Staff. It's like, we don't want any part of this. This is not the war we want to fight. We do not want to fight because we know where this leads, and no one is prepared for this. This is dumb. I just feel like someone is trying to push us towards World War III. And, if I look at history, I look at who created World War I, who created World War II. And the means by which World War I and II were created were lack of diplomacy and lack of hearing the other side's demands at all. And that came mostly from the British with some help from continental Europe.
Tom, you don't think we're already in World War III?
Oh, I do, but but I'm talking about the real kinetic war.
Right, but if you're looking at World War II, right?
America to fight their war. That is what they're doing.
Yeah, they want America to always fight their war because they know that if they deplete us, then this is all about capital flight, guys. This is all about where the capital goes. They are desperate to make sure that the capital doesn't flee Europe. And how do you make the capital not flee Europe? You destabilize the United States as much as humanly possible. In every way. You open the border. You force a political conflict on Capitol Hill. The Fed is, in some ways, fanning those flames by forcing the fiscal divide, but it's actually forcing an acceleration of ending the old path that we were on. So it doesn't quite... That's why I believe the Fed is actually acting in the United States' best interest here. By forcing rates up to 5-6%, you're now forcing real fiscal and political, real fiscal reform potentially, and the real potential for political revolt in the United States, and that ups the timetable on trying to destroy the U.S. by getting us involved in a war we can't afford to fight. And I don't care where that war is. But right now, we're not really fighting that war. All we're doing right now is emptying out our old stockpiles of weapons. Okay, that's all we've really sent Ukraine. We haven't sent them our best stuff. We've sent them all our shit that we didn't want anyway, and that we had already depreciated down. That's what most of the aid that we've sent has been in the form of old military hardware. Europe has sent most of the money. By the way, I saw a chart of the breakdown the other day. It was clear. Europe has been sending them cash, more cash than we've been sending them. We've been sending them mostly bullets and material. And every provocation every event that has looked like it would be a catalyst for the markets to go crazy. Bombing of Nord Stream 2, Kerch Strait Bridge, this Bucha, blah, 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 blah. Since the war started, every one of those has come out of GCHQ. It was Boris Johnson that put the kibosh on a peace deal in March in Ankara, or May of last year, or whenever that was, March or May of last year. It was Boris Johnson who did that. Remember that. It wasn't the United States.
But didn't he come bearing a promise from the United States, among others, that we would help arm and train an army, which we did?
Look, we trained the army. We trained that army.
Yeah, the original one. It was like 10,000 a year for 5 or 6 years.
Since 2014. Since 2014.
But my point is, you trained another one.
Yeah, they don't have another army to train.
I know, not anymore. But that was back then. After Boris showed up, that was what I heard. The deal was we're gonna, all that stuff. It was a promise, but we were a part of it. I think.
Oh, of course we were a part of it. But this was this. See, again, it's who's the architect of the policy. I'm not trying to absolve the United States of their complicity in this. Okay, there are factions within the United States that are absolutely aligned with the Brits on Russia's the enemy. The Newlandistas, the Clintons, that whole wing, the Lindsey Grahams and all that, and the John McCain wing of the Republican Party, the Hillary Clinton wing of the Democratic Party, the think tanks on K Street, members of parts of the Department of Defense, the CIA, and the State Department. Without a doubt, they're all in the tank. They're all orthodox British neoconservatism. It's what's taught at West Point. All of it. We're not getting away from this. But the question is, the question is, it's become our foreign policy, but it wasn't ours originally. It was grafted onto the United States by Wilson during the Wilson administration, and then has proceeded apace since then. And it's what's turned the United States into the quote unquote evil empire. But remember, folks, the real evil empire never ended. They just outsourced their foreign policy and their war making. It's still the same policy. The information sharing is and the bias of the information that feeds into the entire American system still comes from MI6 and GCHQ.
So
Russiagate came from those people. Yeah. Like they were all British agents.
Well, the original source was a Ukrainian PR exec, but she was just saying what she was told. But
the Steele, but the Steele dossier comes from Christopher Steele.
Yeah, he put it together.
There is no former MI6 anybody.
Yeah, I know, I'm aware.
Okay.
But it's funny though. You're basically saying the sun never did set on the British Empire, huh?
Well, no, because God doesn't want those fucking people running around in the dark. Yeah, that's exactly what I'm saying. I'm saying the British Empire hasn't ended. It's ending, and if the United States doesn't do it doesn't give them their eschaton, in British eschatology, as it were. Like, if we don't give them that, then it will be the end of the British Empire. They controlled our monetary system through LIBOR. Okay, it's very London still settles so much of the financial trade in the world, right? Their part in the sanctions regime was to stop insuring Russian oil tankers, because most of the oil was being insured through City of London. This is very important that people forget about this. It's very important. It's why the Russians were like, okay, we'll just send it out without insurance, and then we'll start our own insurance industry. The Iranians did, and you know why the Russians did that? Because that's exactly what Iran did after they were dumped out of Suez and they couldn't insure their tankers. They built their own insurance. They built their own tanker fleet, and they built their own insurance industry to insure their oil, or they sold the oil at a deep discount. Sound familiar? And let the buyer take the risk of running without, quote unquote, insurance because, well, it was too good a deal to pass up. Sell the oil for $20 to $30 a barrel under the market without insurance, as opposed to, with insurance. And then eventually Iran put enough money together that they were able to start insuring their own tankers through NIOC and all the rest of it. And this is exactly what the Russians are doing now. Study how Iran got through the SWIFT expulsion, and then you'll see exactly how Putin did it. He just did it at a larger scale. And he had friends. And he was there to help Iran get through that period, just like China was there for Russia to get through the 2014, 2015 debt crisis. And now everybody has turned around and helped the Russians get through 2022 and 2023. And that's why nobody outside of the West joined the sanctions regime. And the big prize in all of this today, the big prizes, the first one was Saudi Arabia, the second one is Egypt. And if you don't think that all of this is being accelerated because because the real thing that happened during the BRICS, it wasn't the gold-backed currency, which is that was the misdirect. The real point of the BRICS summit was to bring 6 countries into the BRICS, 5 of which control all of the trade corridors around the Middle East and into Europe: Egypt, UAE, Saudi Arabia, Iran, Ethiopia, and then Argentina. But Ethiopia is effectively the BRICS now control the entrance and the exit of the Red Sea. They have the burgeoning financial center of the UAE for the entire Middle East. They have Saudi Arabia, and they have Iran. I mean, and this is why Armenia is now a thing, because we're trying to stop the international North-South transport corridor from, really kicking off and making everybody rich. It's all very typical. This is the geopolitical chessboard, and this is what's always going on. And it's the better way to describe all of this is the war to prevent Asian integration. When you frame it that way, the geopolitics is pretty clear.
All right. Well, sorry, Phil. I know Shane has had a question for a little bit, so I'm going to let him butt in here, and then we'll go to Phil and Nostra. And then I'm also going to try to wrap this in the next 20 or 15 or 20 minutes, hopefully. So,
and hopefully somebody has a question for Bob, because I feel really bad about hogging the mic, guys. I really do. Okay.
Yeah.
So,
all right, Shane, what you got for us, buddy?
Both Bob and Tom, but picking up on some stuff that Bob and I had an offline conversation about the other day.
Sure.
Circle back quite a ways to where Weimar triggered a thought with me, which was, hopefully I'm not circling back to too much repetition in a previous thought, because I missed the first half, but Weimar had me thinking about other commodities, metals that are being overlooked that one can feasibly hold in a tangible manner, whether they have a market like silver or not, because you guys were also, when you were talking about steel and how it's hard to create its own market for it, but yet there's an argument that it could be. Is there anything else that you guys that you feel like is being overlooked that you haven't mentioned in the conversation? If you mentioned it earlier, could you just give quick reference to it, and I could go back and listen to the replay? I'm curious about that. 2 of my other questions were actually answered, kind of, you guys were going back and forth. And then the last piece of the puzzle, I'll just say I have 2 comments that really that resonated with what Bob and Tom are saying. So one is, people underestimate that your local RIA or landlord association is definitely a place that ambassadors precious metal. So, I know several hundred millionaire next door people. Most of them have 50 to 75% of their wealth in real estate. But I can tell you for a fact that they all carry, well, not all, but many of the ones that have been out for like a decade or more carry a substantial amount of their reserves in precious metals. It's just the way they roll. They always have. And at times like this, they're buying more. Bob and I were just having this conversation offline the other day. The second thing, what I really appreciated, Tom, was your whole analogy to your goat farm, because, living in West Michigan for several years, and in the part of the country that we were at being so close to the farmers, you really see what they labor and toil in, and you have that additional appreciation for commodities. We were actually doing an urban garden in Denver before we left there, and we definitely had some appreciation, and we're growing our kids with that appreciation. So I think that with all this geopolitical tension, all the conversations you're having, it really comes back to, what things can endure the fluctuation of currency value and of other market things that we all try to put our money into. So I just want to circle back to that. Is there something else that we have missed or that I missed in the second half of this conversation tonight that you guys would say, hey, this is something to maybe put into your armoire, or something to think about, or maybe something that you feel like in the near future is going to form that's going to have a more formal trading platform that could have value like that? I'm just curious about those things, Bob. I'll start with you and then maybe go to Tom. Thanks, guys. I appreciate the conversation. It's been great. Thanks, Brandon.
Sure. I guess, what was the question?
So, like, for example, when Weimar was talking about still, Bob, he was saying, okay, all the reasons that he felt like it would be difficult for that to really have a trading platform like silver. Is there a commodity or something out there that you guys haven't really addressed the conversation that is kind of rising up and becoming something that we can actually tangibly or feasibly hold, maybe in our house or in our safety deposit box or something like that, that's being underlooked that you guys haven't talked about too much tonight, or something that's on your radar that's kind of a dark horse that could come up and be something interesting later on in the future? I'm curious about that.
You mean just another commodity in general in terms of outside
anything you think is interesting that's on your guys' radar? Because you guys obviously always understand the value of precious metals and everything that goes in that direction. Is there anything interesting that the rest of us aren't paying enough attention to that we could maybe feasibly or tangibly hold or look to hold in the future?
Go ahead.
Yeah, I guess if you want to go ahead.
I just have a really weird one. I stack tin pewter typically, and I buy it at thrift stores and I throw it in a box, but the tin supply long term, I have some questions about it, and you can usually pick it up at a discount if you can buy pewter, and it can be worth, I forget what it's trading at right now. It's usually between 10 and 20 bucks a pound.
Yeah, I guess if you're looking at some type of other, I guess, commodity that's useful, then you're looking at necessities like lead or some type of food or something that's tradable. I mean, David Morgan and I had this conversation a while back. And if you're looking at something that will retain value, like cigarettes or toilet paper or toothpaste, things that you wouldn't think have much value, but when times get tough or if you see supply constraints and high inflation, those types of goods actually start to maintain some semblance of value. I know a lot of people, being here in Idaho, ammo is a big thing, because it's always something that can be traded, or obviously you don't want to trade it with a guy who has a gun and then puts the ammo in the in the gun and then takes everything from you. But I think those types of things would have value. It's hard to say a raw commodity because the problem with gold and silver or the other commodities is they're just typically not hoardable like gold and silver is, and it's also not it's hard to get some type of price discovery on a market that doesn't have maybe something that's actively traded 24 hours a day somewhere in the world. So I guess that would be more of a consideration. Otherwise, you're going to fall into this subjective pricing model that you see like with collectible coins and things like that need to be graded, and then it's up to someone's opinion on what that thing may be worth. And I just try to keep it a little bit simpler, and just say sometimes simple is better, and that metal that's in deliverable form, that's recognizable, whether it be recognizable hallmarks, that type of thing. To me, that provides some degree of value that it's highly recognizable. So I don't know if that kind of answers the question or not.
Can I take a shot at it, Shane, for you?
That was interesting. I really appreciated that, Bob. I'm sorry. Who just spoke?
It's me, Shane, Jim Hunter. Can I take a shot at your question, please?
Oh, I'm all about it.
You're asking for something, if to be simple, I guess, simplify it, that you can maybe put in the closet at your house.
Well, yeah.
I'm a futures broker, and the stuff we trade, okay, about the only thing that you can put in your house outside of precious metals would be copper. All right, it's not a precious metal, but I don't think that there's a great big appreciation going for copper in the next 3 or 5 years like it's had already. Copper used to be 80 cents a pound and went to $4, $4.50, $5, that kind of thing. But if I could maybe offer a little bit of guidance, if you want to put some metals in your closet or gold or silver bars, that kind of thing, you can certainly do that. And then after you've got the metal in your closet for your millionaires next door friends, that kind of thing, you could certainly start looking at mining equities. There's a guy to look at, to follow. His name is Don Durrett. And he talks about a lot of maybe 4 baggers, 5 baggers, up to 10 baggers. If silver goes to 50 and then 100, and gold goes to 2,200 and then 3,000. So, the wild card, I hope not.
Jim, we are kind of, you're cutting me out kind of. You're in the matrix now.
Okay. Jim's points are really well taken. Well, I'll follow up on the copper thing. I like
copper.
Okay, go ahead.
There was a big thing for real estate for us for a long time, where if we went into the house in our C minus, C plus neighborhoods, and they hadn't stripped the copper out, where we could actually offset dramatically our whole plumbing budget, or most of our plumbing budget, by just taking our copper, scrapping it, and putting in PEX. And we would always do that in those C minus neighborhoods, because yes, I think copper is a better long-term solution for a house, but it was too much of a temptation when the house was vacant for people to go in and strip that thing, damage it would do. So
urban mining.
Yeah.
It's called urban mining, and we saw a lot of it. We saw a lot of it during 2008 through 2010.
Yeah.
Nickels, guys. Nickels are 75% copper and 25% nickel.
Well, I do have an added question, and sorry for this, but platinum and palladium, I would assume as well, right? What are your thoughts on that, Bob and Tom?
I've never been a big fan of platinum. I think the market is just not interesting. It never has been. Palladium depends on what happens with the car market. If there's a political revolution in this country, this push towards EVs is going to end. I'm going to sit down and talk with Jim Kunstler on Thursday for my podcast. And one of the things that is real is that EVs are a non-starter. The insurance industry is going to stop insuring EVs coming because of the fire risk very quickly. It's already happening, and because of that alone, if we can reverse the CAFE, the only reason that like the V8s are going away and all these things are happening, the car market, basically the car companies are being regulated to build cars nobody wants, to drive places that the globalists don't want us to drive to, i.e. to work. If that reverses, then I think palladium becomes a very interesting play again, because clearly palladium is important for catalytic converters and all the rest of it. I think that's been its primary investment focus for a long time now. I like to say I'm long guillotines, rope makers, and lead futures, and so yeah, like the thing that's going to work for you is the thing I would really think about is look at your local community and ask yourself what's not being produced there. What goods or services are not being produced, and what markets are underserved. Like I said earlier, I'm over the moon that, well, in the last year, my little town in North Florida got a Tractor Supply and a new butcher shop. Like, these are two big things for us because we didn't have them. So we don't have to drive 10 miles to Lowe's, or we don't have to buy our meat at Publix. We can go and we can keep the money locally. There are businesses that are starving for capital to go forward with. If investors would stop looking abroad and out into the markets and start looking locally again, and it would also do your local banks a world of good, because the money would stay and circulate locally. Like, this is the thing we have to start really thinking about. If we're talking about how are we going to get through this, and what's our how do we accumulate and acquire wealth that's going to be usable in a scenario where, as Jim Rickards likes to put it, where when money dies, right? And if we're hedging against that, there's only so much gold and silver you can really own, because at that point you don't have a local economy to spend it into, because there's nobody making nails locally. There's nobody making screws. There's nobody making, I have a guy up the road who, I buy my firewood from, who put in a sawmill in the last couple of years because his firewood business is so good. He's not put in a sawmill. So I can get rough cut lumber from the guy 4 minutes up the road, right? To do, if I want to do, I want to put up a pole barn or whatever it is on my property. Like, these are the kinds of things that are extremely important. And like, that's the kind of, honestly, that's the kind of investment that, we need to be thinking about, because that's how we're going to get through this. And
sorry about that.
Sorry, that's it. That's my spiel. I'm done.
Yeah. I mean, platinum's an interesting metal, because I think people are may not be aware of the supply constraints coming out of South Africa, but also the hydrogen fuel cell technology that, if that does gain some network appeal, and with technology catching up and making it more affordable, as well as more market penetrating, I think platinum has a huge upside because of its need for in that hydrogen cell configuration. But and that's again a longer term story, maybe for later this decade. But that's
I can speak directly to this, Bob. Again, being a former chemist, working in metal finishing, working in electrolysis nickel boron, I understand the platinum, the 80-20 platinum ruthenium plate is the best hydrogen, the best hydrogen generation catalyst there is, and it's physical, and there's a reason, and there's a reason for it. I can go into, if you want me to go into the metal hydride, bond energy plot diagram, volcano plot, I can do that, but I don't necessarily think we need to do that today. But the problem I have with fuel cells is we made a choice away from them a long time ago. And we had an opportunity to move into fuel cells. We've been doing, PEM fuel cell. There's good PEM fuel cell technology that's 15 years old now. And it still has no market penetration because it's not been allowed to hit the market. It's been regulated out of existence for local hydrogen, for local generation. Like, we should be able to run, small modular reactors. Plug Power's had these things for years that could run off of natural gas, like a natural gas pipeline directly to 150 kilowatt PEM fuel cell with a 23% thermal efficiency. That's far better than solar. And this is 15 years ago. And if the money had been put into, and if the industry wanted that technology, they would go there. I just don't know that. I just don't think that's what they want, because they don't want us to have good, cheap energy. That's been their whole goal. Like, that's the whole Club of Rome thing. It's real. Like, if you look at everything that they've done, it's about putting up toll booths and roadblocks in front of good, abundant, cheap energy. And that's why they want us off of oil. I mean, I hate to say this, but we're working in an environment, a political environment, that is literally anti-human. And so I'd love to tell that story about platinum, but I can't do it in good conscience. So I would love to tell it, but I can't. I hope you're right, Bob. I hope that there's a platinum story in the future, but I haven't seen it yet, because I wanted this to happen 10 years ago, and I made the mistake of even thinking it was going to happen 10 years ago, because it looked like we were on the verge of it. The products were there, the market penetration was happening for them for being used in warehouses, replacing all the propane powered forklifts and whatnot. It was happening. The contracts were being written and whatnot, but I haven't seen Ballard Power or Plug Power or any of those companies. Like, they haven't really done anything at all. And so I don't know.
Yeah. Well, I think Hyundai already has a hydrogen fuel cell car, but I think Toyota's they also have one, but they're looking at ramping up I think they came out with a press release earlier this year talking about how they're wanting to expand that marketplace by I think 2026, 2027.
Right.
But the issue
and to be fair, the EU absolutely wants to go to a hydrogen economy. And from a energetic perspective, from an engineering perspective, versus other fuel sources, hydrogen is something you produce, and it's a net consumer of energy. It's like, engineers have a phrase. It's like pushing a dead whale up a beach, and it's a boondoggle. I think they're going to put money into it. They're going to put billions into it. So there may be a pump and dump investment opportunity there in platinum, but I don't think it's a solution. I think it's going to be another one of these boondoggles like wind and solar that will be capital destructive than it will be capital accretive for the economies that adopt it. So.
All right. Well, we have been going for 2.5 hours. I know that we have a few more hands and questions here, but I don't know. I'm hitting the wall a little bit. So I do appreciate Tom and Bob for their time. I guess this means we'll have to have another one at some point in time. So sorry, Energy and Phil and Nasha for passing up on y'all's questions, but. Yeah, Tom and Bob, why don't you guys give us a little send off here as to where they can find out more about what you guys do and yeah, follow along.
Yeah, well, you can find me here, I guess, on Twitter. I try to put out some good content with regard to precious metals. And then also, I run a depository here in Idaho, one of the largest private depositories in the country. Goldsilvervault.com is our website. We also buy and sell metals. And then, of course, I just for a disclosure, I run a hedge fund as well in the physical metals markets. But I try to provide at least a little bit more structural and market information that may have some actionable type of whether it's actionable in terms of the market or actionable in terms of what to watch out for in the marketplace, in terms of trying to look at different structured programs and things like that, the concerns that people should probably be aware of, that type of thing. So anyone has any questions, feel free to DM me.
You can find me over at goldgoatsandguns.com or tomlolango.me is where the blog is. You can find me on Patreon at patreon.com/goldgoatsandguns, where you can sign up for the newsletter or the I do it 2 bi-weekly video podcast reports where I do technical analysis of the structural the important markets, all the things that we talked about tonight: gold, silver, oil, Bitcoin, the yield curve, the Dow, yada yada yada, and also do bespoke chart cold reads for patrons who ask for them. And we do private blogs as well, but it's a monthly newsletter where we have a portfolio strategy for trying to make sense of all this. And of course, you can find me here on Twitter at TFL1728. And I guarantee that the worst version of me will show up on a daily basis because Twitter is just too much fun not to do that.
Yeah, they're both great follows, so go ahead and give them a follow if you already aren't. And yeah, Tom, Bob, thank you guys so much for your time tonight. And yeah, it was a great one. And also, I'll put this up on my YouTube, and I'll get some good graphics and everything like that in the background too. So be on the lookout for that. So yeah, thanks everybody.
Thanks, guys. Thanks, Brandon, for hosting.
Thanks, guys.
Thank you.
Thanks so much for tuning in, everybody, on the latest episode of the Macro Insights podcast with Tom Luongo, the man. And if you want to catch some more content, go ahead and click this button right here, and you can watch my latest episode with Marty Bent. If you enjoyed this, please hit that like button, hit that subscribe button, help your boy out. All right, I'll see you at the next one.